economists, everything has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
We think it is just a pause as opposed to a phase transition.
People get overwhelmed with information that they can't process, and so they just go, you know what? Risk off.
It's probably not the optimum time to be very overweight on risk.
We are going to see a deceleration in growth, that's for sure. But I think the U.S. consumer will stay quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is ECB Day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Kailey Leinz. Lisa will be back with us on Monday, we're told. Tom, equity futures up 8 points on the S&P, advancing 0.2%. 1 hour, and what are we? 1 hour and 45 minutes away from an ECB decision day. Tom Keene.
Yeah, big yield reversal as well. John, the equity, the carnage in equities here in this correction we've had. I just did a careful calculation and surveillance on Thursday on ECB day. Well, you know, we go out to a certain number of digits. How about a negative 0.60235% market drawdown, John? It's a crisis in equities.
Okay, since we're being snarky, here's the line from Paul Donovan going into the ECB of UBS. You'll love this. Quote, the ECB has set itself a new inflation target to miss, and markets want to know how they intend to go about missing it. Close quote. Tom, that's the story for a lot of people in this market going into this news conference later this morning.
I just did a survey of nominal GDP for Francine Lacroix. Of course, Italy is, Draghi's got his work cut out in Italy. And Finland, I was surprised, really not all that good. Germany, a little better as well. But the bottom line ECB story is they're managing a traditionally lethargic growth, trying to give it some form of oomph.
That's Europe. Let's talk the US. Did you watch the town hall with the president last night, Tom?
No, I missed that.
I missed that too.
Padres doubleheader.
I was sleeping. I think that's when Kailey Leinz wakes up. Kailey, the president making the point
save us, Kailey,
that higher wages are a feature and not a bug of the policies of this administration.
He's just trying to make the case for his infrastructure spending, John. He keeps reiterating again and again that look at what economists and look at what Wall Street is telling you. They're saying it's transitory, therefore it must be. This idea that the pricing pressures occurring as the economy reopens are just going to pass us by. It's not going to stick around forever. And that makes it a lot easier to make the case to pump trillions of dollars more into this economy, or at least in theory, if Chuck Schumer can get his act together there in the Senate, John.
We'll catch up with our Washington correspondent, Anne-Marie Hordern, in about 15 minutes' time on this programme. We'll head down to D.C. Looking forward to that. Let's get you up to speed on the price action going into that ECB decision and jobless claims a little bit later this morning. Equity futures up 8 points on the S&P, advancing 0.2% after the biggest two-day pop on the S&P 500 going back to the middle of May. Outside of that, what a range we've seen on a 10-year yield. Tuesday morning, Tom, at the lows on a 10-year, we were looking at 112.60. At the highs of yesterday, 130, and right now 128.83.
What was the why of the pop yesterday?
I think in the back half of the session, Tom, another light auction, soft auction. This was a 20-year issue. But outside of that, we've had a massive range with not much in between.
Kailey,
and I'm with you, Tom. No
Kailey,
big data
tell me,
points.
You don't look at the auctions. I mean, we leave that to Abramowitz, right?
I don't know. I think we look at the auction since that 7-year a few months ago, Tom.
There you go. Some pushback, Tom, from Kailey Leinz. Have you noticed this? The guest hosts come in.
Yes, I've noticed
Kailey
this.
Leinz, Taylor Riggs, Romaine Bostick, just some Tom Keene pushback. Kailey, good morning.
Yeah, we're just here to stoke the fire a little bit, John. Good morning to you. What a morning it will be. 7:45 a.m. Eastern time, as you say. Just under an hour and 45 minutes from now, we will get that ECB decision, followed by the press conference from Christine Lagarde. What exactly are we going to get in terms of forward guidance changes now that we do have that 2% symmetric inflation target? And what does it mean for ECB credibility? Can they really convince the market that they can reach that target? Of course, that press conference from Christine Lagarde starting at 8:30 a.m. Eastern time. Also at 8:30, we will be getting initial jobless claims data. 350,000 is the print we're looking for. Would be a fresh pandemic low. Of course, we know the Fed watching inflation, but also watching this labor market extremely closely. And what I'm going to be watching extremely closely after the bell earnings. We're going to get a slew of them. Intel, I think, could be interesting. And the reason why is we had Texas Instruments last night blowing it out of the water in the second quarter in terms of 41% revenue growth, but a little cautious on the forecast. Does that indicate that chip demand may be peaking? And what does that mean for some of these chip makers investing so much in bulking up their production capacity? We're also going to get Snapchat, Snap and Twitter earnings as well, looking for what engagement and, of course, advertising revenue is going to look like for those guys, John.
They're the stories for later. And Kailey, thank you. Here's the story story for right here, right now. Didi in the pre-market is down another 3%. The ride-hailing giant over in China. More trouble, Tom. Some great reporting from our team here at Bloomberg. Let me run you through some of the highlights. Chinese regulators are considering serious, perhaps unprecedented penalties for this company after its controversial IPO last month. This according to people familiar with the matter. Regulators, and I think this is the important point here, Tom, seeing the IPO last month despite pushback from the Cyberspace Administration in China as potentially a challenge to Beijing's authority. This story's not going anywhere anytime soon, Tom.
And it's not that it's a story, John. My headline here is it's many stories. It's not just Didi. It's this. And as we've heard from Ambassador Haas and others, this is a sum of beliefs of President Xi over what capitalism should look like under a President Xi.
I agree with you, Tom, and this is the Beijing side of it, but also the U.S. capital markets side of it as well, for this IPO specifically. What were they told before they came public? And what did they disclose and what did they hold back from potential investors? You will not hear the end of this, Tom, for a while.
It's like some people say it started with NBang, the people that bought the Waldorf Astoria. I don't know. What I know is it's a sum of parts where every day there's a drip.
Great reporting from the team here at Bloomberg just to push forward that story. That stock is down by a little more than 3% in the pre-market. We need to push forward to the ECB. That decision coming in 1 hour and about 40 minutes time. Eric Robertson, Standard Chartered Global Head of Research, joins us now for more. Eric, let's start there. For the ECB, can I bring up that line that we had from Mr. Donovan over at UBS? Because that got my attention. The ECB has set itself a new inflation target to miss, and markets want to know how they intend to go about missing it. Would that be your take as well, Eric?
Well, I think that's a very good point. I mean, historically, the ECB has had a very difficult time meeting a price target that was at or just below 2%. So to move the desired inflation target a little bit higher, I think what it tells us is that they're prepared to look through the temporary inflation spike that we're seeing now, and will probably continue with, asset purchases and various forms of quantitative easing to try and build that credibility.
The U.S., Eric, has a boom economy. I believe Europe does not. Is it simply the structure that the ECB has to deal with, that they can't generate a boom economy to help out?
Well, I think that's part of the story, Tom. Look, we've been wondering about this disinflationary liquidity trap that Europe has been struggling with for a number of years. And frankly, we don't think that negative interest rates made things any better. If anything, it probably made it a little bit more difficult for the banking system. And so you have a world where policy rates are at zero, and the financial institutions don't really have a lot of incentive for distributing that excess liquidity to the broader economy. And I think for me, that's, people talk about the structural differences between the U.S. and the European economy, but for me, one of those differences is the nature of the financial system and the banking system.
There's a difference in fiscal policy as well in Europe. It just has not been as robust as it is here in the U.S. when it comes to that stimulus. When we're talking about monetary stimulus, though, and we think about the definitions of persistent and forceful, does that mean more stimulus or just stimulus for longer?
I think it means stimulus for longer. And look, let's go back to the decision to pursue the pandemic emergency purchase program, which is a mouthful, but it's, by our estimation, at the current pace of bond purchases, it's going to take the ECB until probably March of next year to fully utilize that PEP envelope. Now, the question is, if they're still struggling to achieve their inflation target, what do they do after that? Now, the PEP program gave them an enormous amount of flexibility, guys. It allowed them to buy bonds outside of the capital key requirements. Going back to traditional QE would probably have less flexibility, but it allows them to keep those purchases up for a longer period of time. And I think that's what we're faced with.
Well, Eric, the key word here is the E in PEP, emergency, and how we define emergency and how we'd consider the end of emergency and what that looks like. Eric, have you got any idea, and do you expect to get any answers in this news conference later?
In the short term, no. I don't think we'll get a lot of new information there. I think they will have to offer more forward guidance and sort of more verbal commentary about how they plan on achieving some of those new symmetric inflation targets. But I think this is really the challenge, right? I mean, it's the same thing when the Fed first announced average inflation targeting, everybody said, well, it's one thing to talk about wanting higher inflation, but how are you going to achieve that? And I think that question or that debate is infinitely more challenging for the ECB than it is for the Federal Reserve at the moment.
Eric, good to catch up. As always, good to hear from you. Eric Robertson there of Standard Chartered, the global head of research. And Tom, let's just use the ECB's targets, their own targets and their own forecasts. So their new target is a 2% inflation target. Here are the forecasts. 1.9% for 21, 1.5% for 22, and 1.4% for 23. So Mr. Donovan over at UBS, when I read out that line, it might sound a little snarky, but the problem is, Tom, it's spot on. And it's been spot on for a long time. That take that this ECB, regardless of what the target is, they haven't been able to get there on a sustainable basis.
There's hope of this. And what it is, John, is the behavior of what money does. Mr. Robertson alluded to that as well. I've been watching in the United States, John, this wall of money called overnight reserves. I don't pretend to be expert at it, but from a peak of $1 trillion, $1,000 billion, down we go, sigh of relief to $700 billion. And John, very quietly in the recent, say, 7 days, we're starting to creep up again. This is like in Europe. What do you do with the money? What's the incentive of all that government largesse to go out into the private system? It's not there.
You're teeing up the Federal Reserve for next week as well, Tom, July 28th. What are you looking for?
I'm looking for a long day on July 28th. What I'm looking for there, you know, it used to be easy. You'd see what sandwich Greenspan had for lunch. We've gone way beyond that. I'm looking for Chairman Powell to have a delicate press conference. And John, as you alluded to yesterday, also speak to the White House during his press conference.
Yes, we'll head down to D.C. and get the update on the White House in just a moment. That is 5-10 minutes away on this program. For our audience worldwide, here's the price action for you. Up a little more than 0.1% on the S&P, advancing 6 or 7 points. Yields for once. Some stability at 129.33 on 10s, advancing about 0.5 basis point. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Kailey Leinz. It's a beautiful morning in New York City. Good morning. This is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden is dismissing concerns that the U.S. would experience persistent inflation. He told a CNN town hall last night there would be near-term inflation because the economy is still improving. Still, he said that restaurants and others in the hospitality industry might take longer to recover because of hiring difficulties. Senate Republicans have blocked debate on the still unfinished infrastructure plan. They rejected Majority Leader Chuck Schumer's proposal to move ahead while negotiators struggle to complete details of the $579 billion package. Moderate Republicans say they need more time to fill in the details. They say by early next week, there should be enough votes to bring up the proposal. China is considering serious penalties for Didi after the ride-hailing giant's controversial U.S. IPO last month. Regulators see the decision to go public as a challenge to Beijing's authority. The country's cyberspace administration had published back against the IPO. Among the possible penalties for Didi, a fine, suspension of certain operations, or the introduction of a state-owned investor. The actual COVID death toll in India could be as high as a staggering 5 million. Even the most conservative estimate, 1.3 million, would be more than double that of the US, which has the highest recorded death toll from the outbreak. The numbers range from 3 to 10 times India's official count. They were derived from research models and local government data. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
The vast majority of the experts, including Wall Street, are suggesting that it's highly unlikely that it's going to be long-term inflation that's going to get out of hand. There will be near-term inflation because everything is now trying to be picked back up.
The President of the United States speaking at a CNN town hall yesterday evening from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together, alongside us today is Kailey Leinz. Here's the price action right now this Thursday morning. Going into the opening bell, some 3 hours and 12 minutes away. Your S&P 500 looks like this, up 7 points. We advanced 0.16% on the S&P 500, following a really tidy two-day pop on the S&P, supported by higher yields over the last couple of days. 129.33, still south of 130, but a real repricing off the lows of Tuesday morning on a 10-year yield. And going into that ECB decision, 1 hour and change away, Tom, euro dollar 117.92, just south of 118.
Euro dollar not giving me much, maybe a little bit stronger. Euro, John, I would note VIX from 25 into 17.62. That's not a record high VIX number, but it's getting there sprightly with Dow futures up 73 right now. On Washington and on July and the unseemly chaos of this summer, Anne-Marie Horton joins us from Bloomberg, Washington, and their correspondent there. Anne-Marie, the president talked about chaos on filibuster, but I lost count of the number of chaoses Congress is dealing with. What is the character of the messes down there?
I think there's three, really, Tom. And the first one, of course, is the infrastructure package with Senator Chuck Schumer, that cloture vote to try to get it to debate. That ended up backfiring. But it does look like they are wrapping that up in terms of bipartisan support. And we'll probably get another vote on Monday. Senator Schumer himself had to vote no, so he could bring it to the floor again on Monday. That's number one. The second thing is, of course, the debt ceiling. We heard from the Congressional Budget Office yesterday that the debt ceiling goes till July 31st. That was decided last year. And now the Treasury, according to the CBO, has until about October, November in order to keep U.S. government paying its bills. And then the third thing, which I think is becoming a little bit more front and center, is the Delta variant and the spikes we're seeing around the world. And the president really talked about that last night on that CNN town hall.
We talked to Senator Hagerty yesterday of Tennessee. He made clear he's vaccinated, his mother's vaccinated. What can they actually do? What can Southern senators, and frankly, a lot of urban representatives as well, what can they do to get the variant and the unvaccinated going?
It depends who you ask, what direction would be the right approach. At this point, some people say that you just have to pay people to go get vaccinated, these other incentives. Another thing that states could do, and we are seeing it incrementally in certain businesses and universities, are requiring that you have to get a vaccine or you cannot enter. There was a very famous legal case in 1905, Jacobson versus Massachusetts, and this had to do with smallpox and whether or not it was legal to get a smallpox vaccine. And the Supreme Court said, yes, states do have this jurisdiction. It could become mandated. Potentially, the administration want to give that up to the states, but that would be obviously the extreme case, and that would take a lot of political capital to do, but there are other avenues.
Well, let's talk about mandates elsewhere. Masking, Politico this morning, return of the mask, that's the top line. The Washington Post, White House officials debate masking push as COVID infections spike. Anne-Marie, this feels like we're going backwards a little bit with this conversation. What's happening?
Yeah, and Jerome Adams yesterday saying the CDC needs to do this, and he was, of course, the former Surgeon General, because he's just saying that there's no way to track whether or not an individual in the street or in a restaurant is vaccinated or not. And there's no mask mandate. If you're not vaccinated, people are still taking it up saying, well, there's no mask, I don't need to, and no one knows if I'm not vaccinated or not. There is concern in Washington, especially given this week we heard from Press Secretary Jen Psaki talking about there have been breakthrough cases at the White House, and the Washington Post saying that the White House is talking about bringing back a mask mandate. This will be politically very challenging, but it is something that there are discussions, not just in the White House, but also in Congress. But this would come from the CDC, but clearly the administration is having these high-level discussions.
For the administration, there's science, and then there are incentives. The CDC needs to focus on the science exclusively. That's what we expect from them. The administration needs to think about incentives as well. And Mayor Bill de Blasio of New York City is thinking about that too, Anne-Marie. If you start telling people who have gone out and got vaccinated they have to wear masks again and go through the next stage after that, perhaps, and the next step after that, where are the incentives just to get back to normal and go ahead and get one?
Well, the incentives have to lie with those who are not vaccinated. Those that are vaccinated know what the incentives are. Most of us can get on a plane. We can go inside restaurants or shops without having to wear a mask. The tracking is going to be very difficult. Incentives, they've tried a lot of incentives in this country. Lotteries, free tickets. I got a vaccine and was offered and given $25 to use in the drugstore to get it because I was a little bit later on in the year. And an older gentleman walked in and said, I got my vaccine 2 months ago. I didn't get anything for this.
Yeah, that was
so
me.
incentives, I think, were, yeah, no, it wasn't Tom. Tom was in New York. But the incentives, I think, work to a point. Some people are refusing, and the administration is trying everything. They're sending buses to rural areas. You do see a lot of representatives and senators also out there trying to implore individuals to get vaccinated, but it might come to a point where they need to start discussing if there's going to be a vaccine certificate or passport, or just, like I said, universities or shops are not going to let people in unless they have proof of vaccination.
Anne-Marie, it was a week ago today that President Biden was meeting with the German Chancellor Angela Merkel, talking about how he was considering lifting that ban on Europeans coming to the U.S. We would have a decision in the coming days. It's been exactly 7 days, still nothing. Is the Biden administration in a position to do that, considering what is happening domestically?
It's a very good question, and we just don't know. We have not heard yet from the administration on the travel bans, but clearly this Delta variant, and they're even discussing bringing back mask mandate, is going to make it very difficult. One interesting research I read this morning is that there is research that 2 Pfizer jabs and 2 AstraZeneca shots do work against the Delta variant. We do know a lot of Europeans are taking up the AstraZeneca shot. Potentially that could help in this decision-making, but we just don't know yet. The president really punted that decision down the line and has yet to come up with a decision on that travel ban.
What is several days? Is it a week?
More than
is it
7.
2 weeks? Several days
few
until
is
you forget
1 or
about
2,
it?
3, yeah.
I think we're past several.
And it wasn't brought up last night. I mean, really last night he was imploring people to go out and get the vaccine, but travel really wasn't brought up.
Well, the Delta variant is here despite the travel ban. Anne-Marie, down in Washington, D.C. Thank you. Anne-Marie Hordern, Bloomberg Washington correspondent. I want to turn back to the pricing issue, Tom. There was a line from Chipotle recently that jumped out at a lot of people. Quote, no resistance whatsoever to higher prices in the restaurant. It's not just about passing on higher prices. As you and I have talked about for a long time, Tom, it's about consumer price tolerance. And that tolerance seems to be pretty robust at the moment in America.
It is with the GDP where it is. And, of course, there's decile analysis of that, who's being affected the most. This is all new, John. We forget how new and original this boom economy is. Anybody talking with certitude here is just, and I think Powell's captured that, frankly. There's a lot of mysteries out there. And one is, what is a $7 margarita at Chipotle going to do to me?
Can you get a margarita at Chipotle, Tom?
I don't know.
Have you ever been to Chipotle?
Can we test this theory out? I think we should.
We can go and do that after this show, if you like. From New York City this morning. Good morning. Alongside Tom Keene,
56th Street
I'm
at
Jonathan
6th
Ferro. Together with Kailey Leinz. I think Chipotle's on 62nd, Tom. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here is your price action. On the S&P 500, we advance once again. The biggest two-day pop coming into Thursday since the middle of May. Right now, advancing 7 or 8 points, up almost 0.2% on the S&P, up a little more than 1/10 on the Nasdaq 100. The Russell advancing too after a tidy rebound after a really messy couple of months for the small caps in America. We advance another 0.2%. It's about the relationship between this equity market and this bond market. Switch up the board. 2s, 10s and 30s. Yields have been on quite a trip over the last couple of days. The lows of the session on Tuesday, 112.60. The highs of the session on Wednesday, just north of 130. And to Tom's point a little bit earlier in the programme, on what? Not much information in between, with the exception maybe of some long-dated debt coming to market, which was just a little bit messy. That's your bond market at 129.16, unchanged on the day on 10s, but a stability for once on 30s. Still sub 2%, 193.80 on a 30-year yield. Your attention, though, is going to turn away from this bond market towards the FX market very briefly in about 1 hour and 15 minutes time over at the ECB. Switch up the board and get to euro-dollar. Euro-dollar right now, 117.87. We were about one big figure north of this point the day after Francine Lacqua's interview with ECB President Christine Lagarde. And Tom, I wouldn't have been interested in this meeting if it wasn't for ECB President Christine Lagarde saying that we should pay attention because this one was somehow important. Let's see how important that is when we get that information a little more than an hour away.
Don't you agree with me, John, that German 10-year and Swiss 20-year are acting differently than the U.S. 10-year. They sort of have a life of their own.
So I'm going to bring up the Italian 10-year in the next hour, Tom. So just wait for that. That's the tease for 60 minutes' time. Just the development of what's happened with the 10-year yield and why that might be the ultimate target for this ECB and not that 2% number they're throwing around more recently.
We've got a busy section right now. Kaylee, I got to go to you on Southwest Air. This is important. Off United Airlines yesterday or the day before, Southwest hopeful to be profitable in 3Q and 4Q. Kaylee, there's a lot of that hopeful out there.
A lot of hopeful, but they are sounding decidedly less confident than United, that said they will be profitable in the second half of this year. United talking about a full recovery, at least in domestic travel. I wonder if Southwest is seeing that, because they are just hopeful. They aren't sure, Tom, that profits are going to be coming this quarter and the next.
Manus Cranny joining us now from Frankfurt. Manus Cranny, always hopeful to get to a 3-hour lunch in Frankfurt. That's what they specialize in over there, and we welcome him today as he looks at the ECB. Manus, what will Christine Lagarde try to not say today?
What will she try and not say? Well, she'll try and not deflate the doves. She'll try and not allow the euro to fly away. I think it's probably about freedom. That's what she's messaged to the market, Tom. Freedom, because this central bank is in a very structurally different position to the Fed, to the Bank of Canada, to the dissent of the Bank of England, and to the tapering that's going on at the RBNZ. So she does not want to say that they are anywhere near that consideration. They have more slack, they have higher unemployment, they've got an interest rate, they've got an inflation differential, which is wider to where you and Jonathan are sitting. You know, nothing is so permanent, John and Tom, as a permanent government program, read bond buying program. That was part of the note from Alberto Gallo a couple of weeks ago talking about stimulus. But in essence, that's it. What is the flexibility that they have? They want to communicate that, the flexibility in the emergency buying pandemic program that they have. And they want that to hopefully live beyond March of next year in size and scale, enough to keep a cap on the euro and keep those yields, Jonathan, at 0.4%.
That's the big question, Manus. That is the big question. It's the E in PEP, the emergency. And once the emergency ends, how do we transition away from PEP? So, Manus, I wonder whether that new interpretation of their inflation mandate from below but close to 2% to just 2% enables the doves to get their own way. Is that enough?
Language is not enough in this case. Clunky language is something we've lived with for a long time. Put that to one side. This is about communicating what morphing from an emergency bond buying program is to in perpetuity, if you afford me that latitude. The 1.85 trillion should, in theory, mathematically be done by March of next year. With bond yields at 0.4%, however, they may not need to spend all of it. What will you morph and transfer into the bond buying program per se on an ongoing basis? That is where they have the flexibility. That is where they have the ability to cap the euro. That is where they have the ability to deliver the dovish message. Commerzbank chief economist was with me this morning. He presumes another $250 billion or 250 billion if you think it sounds bigger, in terms of bond buying. So this, for me, guys, is all about the flexibility. And that should allay some of the fears of the hawks, because there was, of course, hawks on this committee that wanted to taper bond buying in the minutes of the last ECB meeting. So that's the risk.
Manus, we're running a bit of a book here. $10 that you're in shorts over in Frankfurt after what we saw take place in Zurich. What have we got? What's going on?
When you have very posh guests.
Let's have a look.
When you have very posh guests, it's the full Mark Marango Savile Row with a little bit of Axel
to loosen up, Tom.
For Italian
Manus,
style.
just tell him to loosen up. Tell your cameraman to loosen up a little bit, not come tight. Let you step back.
Apparently, you have to loosen up.
There we go. See? There we go. Very cool. Just checking in, Manus. I've seen you on your Euro tour. Oh, there are the shoes. There are the shoes. Very nice. Manus Cranny.
You know, when it comes to matters of grave importance, gentlemen and ladies, style wins over substance every time.
That's why you're here with us, Manus Cranny, over in Frankfurt, Germany. Thank you, sir. Tom Keene, the always fashionable Manus Cranny, on his European tour from Zurich to Frankfurt.
A lot of value in Zurich, talking to the bankers that have to deal with this interest rate structure. Also dealing with it, John, Katrina Dudley with Franklin Mutual, with a lot of years of European investment experience. And she joins us this morning. Katrina, I love in your research note how you talk about the desire of smooth transition. That is a political process. Are we going to see a smooth transition?
I think we are going to see a very smooth transition. Look, let's be honest. We were all expecting this July meeting to be a complete non-event, but the strategy review actually came out much earlier than expected, and the signaling coming out of the ECB has been all about doing things, symmetrically, doing things consistently, and really they're listening to the market, and the focus is on supporting the market and also supporting the economies of Europe. So I do think that we're in for a very smooth transition here. We're also, though, balancing the hawks and the doves in the ECB, and we need to be, thinking about what could happen at 7:45 when they release their statement.
Italian 10-year is 67 basis points. It seems to a lot of people, Katrina, that that's the ultimate target here, not this 2% number, but to make sure that financial conditions are easy throughout the whole of this cycle. Makes me wonder how stuck they're going to be with these so-called emergency settings for policy beyond COVID throughout the whole of this cycle. What are your thoughts on that?
I think you're really highlighting something that's so important here. For so long covering the European markets, we had something blowing up. And for once in our lives, we're actually looking at a very quiet and mild Europe. Greece seems to be settling in, and Italy is as well. Why is the market and why is the ECB focused on Italy? We had back in May kind of a mini increase in the interest rates or the yields on the bonds over in Italy, and they got scared because Draghi needs support. Draghi is turning around Italy, but in order to do that and in order to do that effectively, he needs the support of the ECB and he needs to keep those rates low. So I think that you're right that they are very much focused on yields, particularly in Italy and other countries in the periphery in particular. Think about all those names that came up in the press over the last couple of years.
Katrina, when Christine Lagarde walks up to that podium today and talks about the balance of risks, she's likely going to have to factor in the Delta variant. Do you see that as posing a real risk to growth, and how do you hedge against it?
I think that the Delta variant is more factored into European forecasts for growth than it is, say, here in the United States, where we're starting to see a spike in cases, but we really haven't seen the same impact. It's more of an issue in the UK, obviously. But Europe, generally speaking, has never been a fast-growing economy. So I don't think it's going to really, impede things. What we think it is that we're just so much earlier in the recovery in Europe. And also Europe has so much more flexibility given that it's early in the recovery. It has much higher unemployment rates and also has a lot more flexibility in terms of its ability through the European Recovery Fund to put money into the economy. And we're going to start to see that beginning next year. And that is incrementally going to be a driver for growth next year. And so I think we can give 2021 a bit of a pass in terms of economic growth, which is when the Delta variant would have the most impact.
Katrina, it's good to hear from you. Thanks for being with us ahead of that ECB decision in about an hour's time. Katrina Dudley there of Franklin Mutual, a portfolio manager. Looking at the chart of the 10-year, and we'll do a little bit of work on this a little bit later in the next hour, of the Italian 10-year. 67 basis points right now, Tom. At the high of the year, that was in spring, and what we saw is something north of 1%. And what I think is important here is what the Fed said and what the ECB did. The Federal Reserve said what this was a validation of a better outlook, not just for the US economy, but for the global economy as well. That's what they said about their high yields on treasuries. Yeah. What the ECB did was start talking about ramping up the pace of purchases in the near term, not the overall size of the envelope, but the pace of purchases, because they were uncomfortable with where yields were going in Europe. And that's why I just wondered, Tom, we talked so much about the inflation mandate over at the ECB, sub 2%. They're forecasting that out a couple of years still. What really matters is financial conditions for the periphery, for the whole of Europe, and you'll hear that again and again and again, I imagine, in the news conference in a couple of hours' time.
And I would go even further, John, not only to move to financial conditions, but I would just go simply to the desire for economic growth and to sustain it, which, of course, goes over to what the politicians care about, which is the labor economy. The arch issue here, and it shows, as we've heard from some of our guests, including Manus Cranney, the idea of every central bank for themselves. Some are getting restrictive, many can't.
And Tom, you're right to highlight the difference as well between what's happening in Europe and what's happening in the United States. We're having a very different inflation conversation in America that's not really taking place in Europe in a material way.
Yeah, there's no question about it. I mean, look at rents. Look at the house shortage.
Yep. Equity futures up 0.2 on the S&P. Yields advancing almost a basis point at 129.66 on 10s. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. It's almost as if the pandemic and the battle between the US and China had never happened. The two countries are shipping goods to each other at the fastest pace in years. China is buying more from American farm goods, and US imports are described as being through the roof. But the US trade deficit hasn't shrunk. Most tariffs are still in place, and there haven't been negotiations over other economic issues. Meanwhile, China is pushing back against the World Health Organization's call for another probe in the coronavirus's origins. The issue, the WHO wants to know if the virus could have leaked from a Chinese lab. Beijing says there's no evidence for that theory, and it defies common sense. Bloomberg's learned that Federal Reserve Chair Jerome Powell has broad support for his renomination among top White House advisors. Still, the decision is expected later this year and hasn't been put in front of President Biden just yet. Powell was appointed as head of the central bank by President Trump. His term expires in February. It's a sign that travel demand is bouncing back. American Airlines is raising its goal for hiring pilots by 50% through next year. That's according to a company memo to pilots. American's new plan calls for hiring more than 1,300 pilots through the end of 2022. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Came out with the pricing for the vaccine when we identified the lead candidate. We discussed early on about offering that at not-for-profit. We did not want access to or cost to be an issue for folks when they're considering getting vaccinated or not. That will come to an end probably towards the end of this year.
Joseph Wolk there, the Johnson & Johnson CFO. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Kailey Leinz. Lisa back with us this coming Monday. Here's your equity market, up 9 or 10 points on the S&P 500. Big two-day pop into Thursday. We add a little bit of weight to that rally on the S&P 500, advancing 0.2%. Yields pushing back to 130. Had a little look at that yesterday. Back at that level right now, 130 flat on 10s. Yields up around about a basis point, and in about 57 minutes time, an ECB decision. Euro dollar unchanged going into that, Tom. Euro dollar 117.93.
Absolutely. Now in the pandemic, and some clear talk here, we've really had a wonderful day yesterday in diving deeper into this Delta variant. Jennifer Nuzzo with us, Johns Hopkins Center for Health Security and a senior scholar. Jennifer, I want to go back to April 26th. April 26th, the EU was really looking at letting American tourists into Europe. There was a better tone. Hospitalizations now, led by the unvaccinated, have returned to where they were April 26, and it is not a good trend. What is the character of those hospitalizations?
Yeah, it is not a good trend. I mean, it is a different patient population than had been hospitalized earlier in the pandemic. In particular, we have fortunately seen good vaccine uptake against the populations that are most likely to become severely ill, the older adults. And so now the people who are being hospitalized are younger. Although age is the single biggest risk factor, it's not the only risk factor. And so certainly people with underlying health conditions, and it's a list, it's a lot of people that fit in that category, but also even potentially people who have no underlying health conditions are unfortunately now being hospitalized. And it's so tragic because vaccines can prevent that from happening.
Jennifer, we used to talk about trying to achieve a 70% vaccination rate in this country. Can you compare and contrast the reproduction rate of this variant, the dominant variant right now, the Delta variant, compared to what we first experienced 18 months ago, and what that means for those kind of goals, whether 70% now needs to be 75, 80, etc.?
Yeah, I mean, it does likely need to be higher. The Delta variant is spreading much more quickly, and it's potentially spreading a bit earlier in people's illness, possibly when they're not even feeling much. So that complicates things. So the fact that if you're sick and you're out and about, you can infect more people than you would have with earlier forms of the virus just makes it harder for public health officials, to outrun it, to use other measures to try to control it. And that's why it's really important that we don't have to do that we can prevent those infections from occurring in the first place. And that's what vaccines are great at doing. Not perfect, but great.
Masks. That's the conversation down in D.C., Jennifer. You know it's back on the table. Politico this morning, return of the mask. The Washington Post going with White House officials debate masking push as COVID infections spike. If you've been vaccinated, Jennifer, what does a mask do for you? What does it do for others?
Sure. Well, listen, as I said before, the vaccines are pretty good at preventing you from getting infected. That said, we know that there are some people who are still going to get ill potentially, but it'll keep them out of the hospital. It'll be mild. It'll be the kind of illness that if that's all the virus could do, we would have never heard of this virus in the first place. So if you're somebody in that category where you don't want to get that illness, then wearing a mask, even though you're vaccinated, may be helpful. Your need to do that is greater when you're in a place where there's just a lot more illness around you, where people are more likely to be infected, where there's lower protection overall in the community because of low vaccination rates. That said, don't believe that the vaccines don't, give you some protection. I think there's been a rising narrative about that it's really disturbing to me.
Are schools one of those places where you need to be more careful? Jennifer, my home state of Virginia yesterday urging everyone in an elementary school, students, teachers alike, to mask up, given under 12 still aren't vaccinated. As we approach the school year, is it safe for students to be returning?
Sure. So first of all, we know that it is possible to return children to school safely, and it's really essential that we do so after this past year and a half of educational disruption. That itself carries harms. I've got 2 young kids who are too young to be vaccinated, so I'm very much in that boat. So we can do it safely. Now, it has been recommended that kids, particularly those who can't be vaccinated, wear masks. Truthfully, I think it's going to depend on what the level of infection in the community is. If you're in a community that has done its part, has vaccinated its adults, and there are very few cases, it seems hard to think that you need to wear masks in schools. That said, if you want to have zero risk tolerance and let's just get them back and make sure they're as safe as possible, then that's an important tool to use. I think in schools where the case numbers in the surrounding communities are raging, then masks are probably an important tool, because we do know that if there are cases among kids in schools, it follows what happens in the surrounding community. I do have to stress, though, that overall kids are at lower risk of serious illness from all forms of the virus, including the Delta variant. There's been some, I think, confusing conversation about that lately. And as a parent, I would want other parents to know that. So, we face those risks with what data we have right now.
Well, Jennifer, school is not back in session yet. It is still summer vacation, and it's the summer season in Europe, too. And yet anyone in Europe looking to take a vacation in the U.S. still can't do that. The Biden administration hasn't yet made a decision. If you were advising the president and the people around him as to whether or not that's safe, given the concerns of the Delta variant, what would you say?
Well, first of all, the Delta variant is already here and it's raging. So if we're not letting people in because we want to keep it out, then that ship has already sailed. I think there's probably political pressures to keep the border closed because people, and to prevent people from coming because it's probably just easier. But I'm not convinced that it's doing much for us epidemiologically.
Is it politics or is it science? That's the big question right now. And a lot of people keep saying it's about politics, including yourself, Jennifer. It's good to catch up. Jennifer Nuzzo,
so
Johns Hopkins Center for House Security Senior Scholar. On that Washington Post piece, Tom, here's the lead paragraph. Top White House officials and Biden administration officials are debating whether they should urge vaccinated Americans to wear masks in more settings as the Delta variant causes spikes in coronavirus infections across the country. This according to 6 people familiar with the discussions.
You got to see what it is store to store. I mean, in New York, it's a whole different calculus. Our colleague John Paul Sweeney speaking to someone yesterday in Kentucky, they made it very clear Kentucky has reverted back to where it was many months ago. I don't have that feeling in New York City.
Kailey, right to bring up the return to school effort, the return to work effort as well, Kailey. Apple, reportedly, from our reporters over the last week, pushing that back a month, maybe to October. You do wonder who else is going to follow here.
Well, especially on Wall Street, John, because post-Labor Day in September, when all of the banks are expected to have more workers returning to the office, my neighborhood down in the financial district, I would think, is going to be a lot more crowded, but does that conversation begin to change as we see these Delta variant concerns? And it also brings up the question of requiring employees to be vaccinated, or at least report their vaccination status. They're doing it in hospitals here in New York. Is that going to extend to other industries as well?
Big push to get back to work on Wall Street. Who's the latest to pay 100K? Kailey, who's the latest?
UBS.
UBS.
Join in the ranks.
One. First year out of school, Tom. 100K seems to just be the benchmark now.
It's a new benchmark. You know,
on Wall Street.
And what's important is what happens 6 months after that, 1 year after that, 2 years after that. I mean, they get on a track, and, you know, that's what you've got to do to make these kids go 70 hours a week.
The S&P up 10, advancing 0.2%, going into the ECB euro dollar 117.94 unchanged, and yields pushing higher.
Yeah.
Back through 130 at 130.50 on 10s. From New York, this is Bloomberg.
Almost everything has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
We think it is just a pause as opposed to a phased transition.
People get overwhelmed with information that they can't process, and so they just go, you know what? Risk off.
It's probably not the optimum time to be very overweight on risk.
We are going to see a deceleration in growth, that's for sure. But I think the U.S. consumer will stay quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The ECB, 45 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Kailey Leinz. Lisa back with us on Monday. Here's your equity market, pushing higher again, up 0.2% on the S&P. The small caps, what a run we've had over the last couple of days, Tom. Up 4.85% over the previous two sessions coming into Thursday.
Buy the dip wins again. And what's interesting about this, John, is I've heard a lot of people recalibrating for caution. We hear about quality portfolios being defensive, and that into this earnings season after what we saw with Texas Instruments yesterday. You wonder how defensive goes in the next 6 weeks.
Yeah, a bit disappointing on that front, Tom, but elsewhere, Coca-Cola, tidy. United Airlines, nice
Tidy,
forward
yeah.
look. Chipotle. I think the pricing issue and how they handle the prices as they pass
Yeah.
them through to consumers, they are seeing consumer price tolerance. We mentioned that in a previous hour. That's critical.
I agree, but the word I love that you use there, John, is tidy. And that's what they're doing. Tidy to me means corporations are adapting to the cards they've been dealt, and that's what we're seeing on the Bloomberg terminal right now.
And Kailey, we're trying to adapt to what comes next down in Washington, D.C. At the start of the year, it was plain and obvious, more, now less so.
It is less so, John. And when we're talking about infrastructure spending, as expected, Chuck Schumer losing a vote to open debate around that $579 billion bipartisan plan. But we call it a plan. It's not actually complete yet. We still don't have the pay-fors, which is another thing that this market has to consider when we talk about this long-term economic spending. How are we going to pay for it? Have we all forgotten about the threat of higher taxes, John?
Well, let's talk about this market, and then we'll get to that down in Washington in just a moment. Your equity market shaping up as follows this Thursday morning. 43 minutes away from an ECB decision. Equities pushing higher once again on the S&P. We advanced by 9 points, by 0.2%. In the bond market, yields higher by a basis point to 130 on a US 10-year. And in foreign exchange, euro dollar 117.92, 117.92 flat going into that decision 40 minutes away. Kailey.
John, remember when we were at 123? I wonder if that decision coming up at 7:45 a.m. Eastern time changes that equation for the euro. What exactly is forward guidance going to look like now that we have a exactly 2% symmetric inflation target? And what does forceful and persistent mean? What is Webster going to put in the dictionary when it comes to what those words mean for the ECB? Of course, Christine Lagarde will be taking the podium at 8:30 a.m. Eastern time. At the same time, we also are going to get some important economic data here in the U.S. Initial continuing jobless claims for last week coming through 350,000, a fresh pandemic low is what we're looking for. And John, you were talking about, and Tom as well, that chip conversation with Texas Instruments last night. That guidance coming in a lot lighter than analysts anticipated. Are they just being conservative, or is that sending a signal to the entire chip-making sector that maybe demand is peaking now and all of that money they are putting into upping their capacity, if it's not met with that demand, if it is an overshoot, what is it going to mean for the profitability of some of these companies like Intel, which we will get reporting after the bell, along with Snap and Twitter? Tom and John.
Thank you very much, Kailey. Just want to check in on Didi just quickly in the pre-market. Didn't talk enough about that in the previous hour, Tom. Didi down in the pre-market off the back of news from our team here at Bloomberg, suggesting Chinese regulators are seriously considering perhaps unprecedented penalties for DD Global after its controversial IPO last month. Regulators seeing this particular company's decision to go public, despite pushback from the Cyberspace Administration of China, as a direct challenge to Beijing's authority. More weakness on that stock, 11.28, down by 1.9%.
You really want to, how it redounds back to global Wall Street, and particularly New York Wall Street, John. It's going to be an interesting story in the coming weeks. John, you mentioned United Airlines. We mentioned Southwest Air earlier, American Airlines out with the debris. It's down 20% capacity. To me, it's pretty good. I mean, I think, I know the planes have been hammered here, and AAL is down a little bit fractionally here. But, John, I mean, given the natural disaster they were given, to be down 20% in capacity, to me is not that bad.
The fact that some of these airlines still exist, Tom, is testament to the policy initiatives we've had over the last 18 months and some of the hard work these companies have done too. But largely, I have to say, because of the policy initiatives over the last 18 months. And anyone that's flown domestically knows the planes are full. But when you're in the airport, Tom, the airports in many places, including JFK, are still pretty quiet.
Yes.
They're still pretty quiet because the capacity is not there.
Really, really well said. This idea that the planes, they're managing it and all that. International is a disaster, as we know. But the proof of the pudding is the airlines. I mean, I yearn to go to Heathrow, John, and outside of Burberry on the way to Bottega, there's that Fortune and Mason tea place.
You like that, don't you?
Yeah.
Whenever we travel together, I've noticed that you stop off at Fortnum and Mason's for a cup of tea in Terminal 5.
I pick up a tea, yes.
I've noticed. Okay, let's move on with Sean Snyder, Citi US Wealth Management Head of Investment Strategy. Sean, small caps have had a nice run the last 2 days. It's been tough, though, since March. We topped out then. And I think a lot of people are trying to understand, when they see this weakness in the cyclicals, is it weakness they should buy? What's the process they should work through to understand the answer to that question?
So we're actually underweight small cap U.S. stocks, and the reason is because you tend to see a strong recovery in small caps very early on in the cycle, and then as the cycle matures more into a mid-cycle expansion, they don't perform quite as well. We actually like large caps a little bit better here, particularly with the Delta variant spreading across some regions, because we think investors will kind of go back into some of those familiar growth names or technology names. So, small cap will probably continue to do okay, right? I mean, we have an economy that's going to continue to grow, but the largest gains may be behind us.
Sean, I want to talk about your sustainable drivers and the idea of the FANGs is sustainable drivers. Next week we go into that earnings season. What should we expect?
I think you're going to continue to see strong earnings growth. I mean, I do think that if you look at value versus growth, I think you're going to see much better earnings coming out of the value companies. I think expectations for 2Q is 154% EPS growth year on year for value, and something like 54% for the technology space or for the growth companies in particular. So, you're going to get better beats, I think, out of the value companies. But again, still strong, EPS growth for those technology names, even though maybe we're not using them quite as much as we were in the early on in the pandemic, but I think earnings look quite good. You got 86% thus far, beating expectations on earnings, and I think 72% beating on revenues. So pretty good earnings season.
So, Sean, when you're looking at this equity market right now, is that what you're thinking about, just the earnings story? Forget what else is happening in other asset classes, the cues you might be getting from the bond market and what it's signaling about growth. Is earnings all that matters?
No, I don't think that's true. I mean, I think earnings do matter. I think it's one of the reasons that we do think that, this value trade is probably not over. We do think that we'll see upside revisions to earnings in that space, and that will eventually kind of drive it higher. But to say that it's the only thing we're thinking about is probably not true. I do think the Delta variant is something we have to consider. Bloomberg has an excellent vaccine tracker, and if you look at that, they have some great quotes and stats. And the least wealthy 50 nations have 2% of the vaccinations and 20% of the population. And you have the wealthier countries getting vaccinated at a pace that's 30 times faster than the least wealthy. So, I do think it's very relevant, particularly in unvaccinated areas. So we need to keep an eye on that. I don't think it derails global growth, but maybe it delays it in some regions. And I do think it's something we have to keep an eye on. So one of the things we're doing, aside from watching earnings, is also looking at dividend growers and the so-called dividend aristocrats, and companies that are more stable and return cash over time, and upgrading the quality of our portfolio.
Where are you finding them, Sean?
Sorry, what's that?
Where are you finding them, the Dividend Aristocrats? Where are they right now?
So, we, in the U.S., but also overseas, if you look at UK equities, you have a significant discount to U.S. equities. And you also have a dividend payment or dividend yield on the FTSE 100 of about 4.2%. So, we're finding them, not just in the U.S., but also overseas as well.
Sean Snyder of Citi, US Wealth Management Head of Investment Strategy. Sean, it's good to catch up, sir. Thank you. Pushing ahead to some of the events you need to be looking for. In about 40 minutes' time, we'll have an ECB rate decision, some guidance possibly updated by President Christine Lagarde, and then, Tom, the news conference later.
Let's stop the show and talk to somebody who actually knows what he's doing. The first time I saw Ferro, I said, who is this guy with a British accent on the lawn at Frankfurt?
I'm pleased you were polite about me, Tom. I don't know how many years we're going back. Carry on, please. Proceed.
Few years. John, what do you expect today? Let's be honest. It's a better press conference. It has smarter questions. She's 4 miles away at those modern. They have podia.
They
John.
do have podiums,
they have
don't
podia
they? I've noticed that too.
Who
Tom.
designed that?
I don't know.
It looks like a Daniel Craig Bond movie where you're like, God, what they.
Do you prefer the podium to the desk?
Yeah.
I'd love your view on that.
No, I prefer the desk.
Okay.
To the podia, but. Well, what do you actually expect the questions to center around?
I think the questions will center around the Pandemic Emergency Purchase Program, Tom, and how they define the end of emergency and what it transitions to and what that flexibility looks like. Because this on the margin is just a very, very subtle change of their interpretation of their inflation mandate from a little bit close to 2% to just 2%. That's not big.
Okay, John, it's all inside baseball. Isn't somebody going to raise their hand and say, what's the Bundesbank think?
I think they will ask that. Unanimity is going to be really important, Tom. I think they will ask that. And whether that change, look, the framework at the Federal Reserve, what that's achieved now, I think, has bound the hands of pretty much everyone. And all we're really debating over at the Federal Reserve is when to start tapering or not. Everyone's pretty on board with this new framework shift over at the Fed. And when we talk about the Federal Reserve, we're talking about a spectrum of doves over at the Federal Reserve, Tom. A spectrum of doves, the most dovish to the least dovish. That old debate between doves and hawks has gone over at the Fed. I think at the ECB, to some extent, Tom, that still exists, and that's the conversation we'll have a little bit later this morning.
I miss Lisa. Look, Kylie, I miss Lisa so much because she would be talking about the pendulum of doves.
Of doves. The pendulum of doves.
The pendulum of doves.
I miss Lisa too. She's going to be back on Monday.
So she says.
You think she's going to have another week off?
She's back in Greece.
She does.
Back in Greece again.
She's in my big.
Nice.
Not on Crete.
Not on Crete, you're right. Up 0.2 on the S&P. We advanced 7 points. Yields higher by a basis point or two. Through 130 on 10s for our audience worldwide. Heard on radio, seen on TV. I can confirm Lisa should be back on Monday. I can confirm. This is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden is dismissing concerns that the U.S. would experience persistent inflation. He told a CNN town hall last night there will be near-term inflation because the economy is still improving. Still, he said that restaurants and others in the hospitality industry might take longer to recover because of hiring difficulties. Senate Republicans have blocked debate on the still unfinished infrastructure plan. They rejected Majority Leader Chuck Schumer's proposal to move ahead while negotiators struggle to complete details of the $579 billion package. Moderate Republicans say they need more time to fill in the details. They say by early next week there should be enough votes to bring up the proposal. The actual COVID death toll in India could be as high as a staggering 5 million. Even the most conservative estimate, 1.3 million, would be more than double that of the US, which has the highest recorded death toll from the outbreak. The numbers range from 3 to 10 times India's official count. They were derived from research models and local government data. AT&T posted second quarter revenue and profit that beat estimates. The company added more than 1.1 million wireless customers. Analysts had expected about 300,000. Meanwhile, the Warner Media unit had a 31% increase in revenue. There was continuing growth in subscribers to the HBO Max video service. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
There's no outcome yet, no bipartisan agreement, certainly nothing on which to vote. Not yet. So obviously, if the Democratic leader tries to force a cloture vote on a bill that does not exist, it will fail.
That was the message from Senate Minority Leader Mitch McConnell there down in Washington, D.C. Here in New York City, good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Kailey Leinz. Lisa back with us on Monday. Here's the price action going into that ECB rate decision in about 20 minutes' time. Your equity market looks like this, up 8 on the S&P, advancing almost 0.2%. Yields are higher by almost a full basis point here, just about getting through 130 earlier, 129.83 right now, Tom. Euro dollar unchanged at 117.90. Unchanged going into that ECB decision. And just around the big debate, inflation. The debate in Europe different to the debate here, Tom. And let me set you up for the debate in America right now. Paul Donovan of UBS, always a must-read most mornings with his daily update. Here's the two lines from him that gets your attention around this, Tom. President Biden said car prices were returning to pre-pandemic levels, which is not true. US Senate Minority Leader Mitch McConnell said inflation was driving the cost of everything through the roof, which is not true. There's a lot of things happening down in D.C. in this front, Tom, which is not true.
What is true is the 2022 primaries beckon.
Yep.
And, John, I can't emphasize enough that they're already counting the odds there of political shifts in the House and the Senate. And that's what is true in Washington as well. Let's get an update on this from Jack Fitzpatrick with Bloomberg Government in Washington. Jack, what are they going to do on a fractured House and a fractured Senate today? After what we've seen, the cacophony of the last 48 hours, what do you presume to see on this Thursday?
On this Thursday and in the next few days, there's going to be sort of the recovery from the failed vote in the Senate, the procedural vote on the infrastructure deal that is not yet an entire deal. So we are watching meeting after meeting, particularly in the Senate, to see if they can wrap up the details. It does look like we could have another vote early next week. Mitt Romney said Monday or Tuesday there could be a deal ready to go. But really what's happening in Washington now is just trying to finish up the very last details of how to pay for the infrastructure measure. Also, they work short weeks typically in Congress. So on Thursday, they take a couple votes and leave.
This is Surveillance Break exclusive, folks. Your politicians work short weeks. Jet Fitzpatrick does not. But the short week gets to the August recess. The senator from New York, the majority leader, wants to, what does he want to do? Extend the short work week so they get to a shorter August recess?
It will very likely be a shorter August week recess because of infrastructure, the slow developments there, the slow progress on the budget plan that would then allow Democrats to try to pass their $3.5 trillion bill without Republican support. And also the debt limit is a strange one. I would point out the House right now is not even scheduled to come back until September 20th for their August recess. We don't know exactly when the debt limit deadline is going to be. It's probably more like October or November. But that combined with the fact that they need to fund the government by September.
I got 8 ways to go here, John, but what's sick to me is Fitzpatrick says this with a straight face.
The length of the recess down in Washington, Tom.
Lisa's on a July recess.
She is.
I mean, that's
I've
what
no
it
idea
is.
when Lisa comes back. Jack, get back to work is the message for a lot of people in this country right now. Get back to work on Wall Street. There was a restaurateur speaking to the president yesterday in that CNN town hall. He wants people to get back to work as well. What did you make of the president's response?
On the UI stuff, I believe, if I'm recalling correctly, you know, the debate over unemployment and the UI unemployment insurance stuff is kind of stagnated. I may have, I'm not sure if I'm remembering the exact response he made that you're referring to, but in Washington, there is, with 2022 in mind, a very partisan debate over the presence of the continued unemployment insurance payments and also the expectation that they're set to end in September anyway. I'm not sure that was as significant a response in my mind as what you're referring to, I'll admit.
Well, the quote that I'm looking at right now, we're ending all of those things. It will be interesting to see what happens. Jack, it's not exactly a stern defense of this administration's policies, is it?
No, Democrats have kind of backed off of that for probably a month now. Republicans have pushed and said we need to get people back to work. There are some Democrats who would like those payments, are happy that those payments are still going out, but the president has said a few times now, look, they're set to end in September. It's a debate that they don't really want to have. So it seems that I think for a few weeks, if not a month or more, the president's tone on that has consistently been, well, we don't need to fight over this anymore. It's ending in the relatively near future.
Well, there is still plenty that they are fighting over, Jack. They haven't even really figured out how they're going to pay for the $579 billion bipartisan package, let alone the trillions else. What are the pay-fors on the table that they are now discussing? Are we still talking about higher corporate taxes, or is that a conversation that died a few months ago?
That one is on the table for what would be a partisan Democratic bill in this next big bill, the $3.5 trillion reconciliation bill. Tax increases are on the table. There's still the question if they can wrangle the votes even just among Democrats for that. But corporate tax increases, an increase on the highest individual tax rate, those are on the table for the later bill. We have seen the conversation for this bipartisan infrastructure measure get much more gimmicky and less focused on actual tax increases. We're probably going to see, and we've seen essentially bullet points for extending customs fees that were set legally to end but probably weren't going to. This first bill that has bipartisan backing is not going to be tax increases. It's going to be sort of legislative creativity, I guess, to call it entirely paid for. The next one is where you should keep an eye out for actual tax increases.
Legislative creativity. We like that, Jack. It's good to catch up. It's good to see you. Jack Fitzpatrick, Bloomberg government reporter. It's the debate right now. Inflation in America, higher prices, the higher cost of living. I do wonder, Tom, whether it's the debate of the moment in 12, 18 months' time as we get closer to those midterms.
The answer is we don't know. It's as simple as that, John. If it is a debate, then it's really, really important. But I would go, as we've heard from a number of guests, there's all these different series of inflation. Two matter. The one in your kitchen, when you're talking about inflation, tuition, service sector, the rest, rents. And the other, John, is a median statistic out of Atlanta and, out of Cleveland, and we'll just have to see where they go. The one thing, John, they can agree on in Washington, we're T-minus 65 minutes to jobless claims.
Yeah.
We're T-minus 19 hours, 42 minutes, 12 seconds. To Ted Lasso tomorrow.
You're excited about this, aren't you?
Oh, it's a big deal.
I was thinking of just skipping to season 2 and not
no,
watching season 1.
It'd be the same thing if it was Mandalorian or Queen's.
Why
the
can't I just skip
shows.
season 1? I get the essence of it, Tom.
You need to get attached to the characters.
Come on, Kailey, back me up here.
No, I'm with Tom on this one.
I need
Roy,
you, John,
Keeley,
to watch
Rebecca.
season 1 so you can
know all the names.
explain.
All of them. They're like family.
They're like family
Watch
to
the first
Kailey
season,
Leinz.
John. You'll understand.
They're like family to you. Are you okay?
Slight
okay?
over-exaggeration.
All right.
John,
Thanks for being with us,
season.
Kailey. It's okay. We're friends. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio, here's the price action this Thursday. Going into that ECB decision, 15 minutes away. Equity futures elevated over the last couple of days, advancing again this morning. We had some weight to the S&P up around about 4 or 5 points, up 0.1%. On the S&P 500 into Thursday, a 2-day gain, the biggest 2-day pop going back to the middle of May. For the Russell, the small caps, a gain of almost 5% over just 2 sessions after a pretty ugly couple of months after topping out back in March. Your Russell this morning, your small caps advancing a little more than 0.1%. The why? Well, the why is in the bond market. Switch up the board and get to the bond market. 2s, 10s and 30s, they look like this morning. Your 10-year yield just sub 130 at 129.66. Had a little look north of 130 earlier today and earlier in the session yesterday. But just think about the range. I keep going back to this. We've gone from 112.60 at the low on Tuesday through 130 yesterday and through 130 today on pretty much nothing. On pretty much nothing. This bond market in a life of its own, and it's driving this equity market in a big way too, Tom. I want to finish on this. Switch up the board and get to the bond market in Europe. Here's a line for you. Target what you can control. The ECB is targeting 2% inflation. Can they control inflation in Europe? That's the big debate in Europe, and that debate is going to continue. But this is something they can control because they've proven it again and again and again. It's the Italian 10-year. We were north of 1% earlier in the year. We're back to 67 basis points on a 10-year. And for many people, Tom, and BMO alluding to this in their note in the last 24 hours, this is what it's really about. It's about financial conditions and keeping them loose, loose, loose as we keep this recovery going in Europe.
And we're going to call that dovish, but can Frankfurt and Madame Lagarde, can she control the Germanic fear of inflation?
That's the big test. That's the big test. To take the inflation target, Tom, from below but close to 2% to just 2%.
Just symmetric.
That's one thing. OK, whatever. Let's move on from that. The real task now is for March next year. It's the flexibility involved in the Pandemic Emergency Purchase Programme, with the E part being the key factor here, emergency. Once the emergency passes, can they retain the flexibility and keep on buying in the periphery in large amounts if they need to? That's the test for Christine Lagarde, Tom.
We will have to see. Right now, we need to interrupt the program and go to Important Surveillance Special Edition with Kailey Leinz. We got to do this before Romaine Bostick. I mean, Kailey Leinz, Domino's in with earnings. I mean, you know, they mention you in the press release.
Yeah, they should. Domino's is one of my favorite forms of food. It could be its own food group for me, Tom. Revenue coming in above estimates. Bottom line coming in above estimates. I would like to think I was a contributing factor to that. The garlic crust, that's what does it.
We're glad to see it in the press.
Does Kailey Leinz eat Domino's?
She
all the time.
Really?
All the time.
I did not know this.
Yeah, Afterthoughts the same way. I think I slipped out with 2 pieces of Domino's pizza this morning. A little bit aged, I should
This show
say.
really is off the rails, isn't it?
It is
Tom,
off the
we need
rails.
to get some movers outside of Domino's.
Yeah, Romaine will save it.
Romaine's got them. Good morning, Romaine.
We're in New York City. Yeah, I think that's the sound of a lot of New York Italians just cringing in fear. All right, let's take a look here at some of the individual movers. And we really want to talk today really about what's going on in the chip sector, because a lot of activity right now in the pre-market surrounds a lot of these chip names here. Keep in mind, you had Texas Instruments last night, and we should talk about a company that was pretty much saved by the pandemic. This was a company that had seen a retraction in revenue growth for 7 straight quarters. Then the pandemic hit, and all of a sudden it was hitting double-digit revenue growth for the last 4 quarters, including 41% in Q2. But it really got a barrage of questions on the conference call last night, all about whether there was some sort of peak here and whether things were going to revert back to the norm, which for Texas Instruments was a retraction in growth. The company didn't seem to have an answer for that. They talked about how their backlog was relatively high. They talked about how their inventory was relatively low, and this would all work in their favors. Analysts really weren't buying it here. You've seen that reflected in the shares, down about 4.5%. And most analysts that we've talked to, they're saying they actually expect this company to get back down into single-digit growth as soon as Q4 and maybe into negative territory by next year. Different story here for ASML, which of course is the big European company that makes the machines that make semiconductors. This company's also been posting double-digit growth. It says it can sustain that primarily because it sort of has a monopoly on these type of UV machines that make this. Then of course, that brings us to Intel, which has basically been the problem child all around. It never really rebounded during the pandemic. It continued to post negative quarters here on a revenue basis. That's expected to continue when they report earnings here tonight after the bell. 6% drop in revenue growth. They're really losing ground to AMD, and they have a much narrower business than Texas Instruments, much more focus here on those data centers that they really haven't been able to get out in front of AMD and some of their other competitors, including NVIDIA. You flip up the board, we heard from Whirlpool last night. They reported earnings, and they did talk about that chip shortage, but they said they were actually able to raise prices by about 12% in the most recent quarter. That helped them post earnings and EPS that beat the average estimates out there. You're seeing the shares only up fractionally here in the pre-market, but the company gave a relatively aggressive forecast. D.R. Horton going in the opposite direction, down about 4%. A lot of concerns about a peak there in the housing market. And after the bell, we are going to get Twitter earnings as well as Snap.
After the bell to close, the Romaine Bostick. Look for that this afternoon as well. Right now, this is way, way important. We've been off the radar on this. It's good to do this 10 minutes before an ECB decision. On short paper, I call it the trust market. Zach Griffiths is expert at this, Wells Fargo senior market strategist. Zach, we went out to $1 trillion overnight reserves. We came back. Massive sigh of relief, and in the last 5 or 6 days, up we go, not through $1 trillion, but 800 whatever gazillion dollars as well. Explain to our radio and television audience why I should care about overnight reserves.
Well, Tom, I don't think you need to care that much because the facility at this point is doing what it needs to do. It's draining reserves from the system, as we really have a financial system that's awash with cash, as Treasury drains down its general account at the Fed, and we still have the Fed buying $120 billion in assets per month. So you have a ton of cash in the system. It's been taken out of the system by the Fed by having this reverse repo facility that is now more attractive at 5 basis points. So that's taking a little bit of pressure off other front-end rates such as bills and the repo market. But we do see that coming under more pressure over the next several days as we have another debt ceiling episode coming up at the end of this month. But so far, the facility has taken on a ton of cash. It's working the way it's supposed to. And we think that overall that's been an encouraging sign, given that where we were with nearly negative bill yields across the curve previously, the adjustment to the Fed's administered rates has taken some concern off of negative yields at the front end of the curve.
Zach, in about 10 minutes, we'll be knee-deep up to our necks, maybe, with the ECB. Next week is about the Federal Reserve, and we haven't talked enough about this. How does the bond market move over the last couple of weeks, the last couple of months, change things, if at all, for this Federal Reserve?
John, I don't think it changes things too much. And what we're really going to be watching for is if the Fed in any way changes its forward guidance with respect to asset purchases. I'd say that Chairman Powell's testimony before Congress remained resolutely dovish. In his prepared remarks, he still says that substantial further progress is a ways off. I think that's a key phrase that we're really keeping an eye on to understand if the Fed really is inching toward tapering asset purchases at some point. And I'd say with the 10-year yield at 1.3%, it's a little bit easier to announce a reduction in asset purchases perhaps than when it was at 1.75% at the end of Q1. So overall, I think perhaps the taper is a little bit easier for the market to digest. Perhaps concerns about tightening financial conditions too much have been taken off the table. So on balance, perhaps it helps with the taper enactment, but it remains to be seen, and they've been addressing it and moving towards it very gradually.
Zach, there's a belief that the Federal Reserve chairman is in the driving seat here. It's not exactly misplaced. We've seen that again and again and again with various Fed chairs over the years, over the decades. But I remember the Bank of England Governor Mervyn King towards the end of his tenure pushing for more QE and getting voted down. It's happened. It's unusual, but it's happened. And I just wonder that divide between the Federal Reserve chair and the core of this Fed and the hawks in the Fed presidents, how big is that divide right now? And is it building towards the hawkish side?
I think right now that the divide is fairly small, and with respect to perhaps those policymakers that disagree with the core a bit, they may be a little bit less emboldened to challenge the core, given the latest news yesterday suggests that Chairman Powell has broad support for another term, and that could be supportive for the core initiative of remaining dovish, really embracing this new longer run framework of flexible average inflation targeting, and really just institutionalizing a more dovish stance longer run toward monetary policy.
Zach, John asked you how the Fed is likely to react to the moves in the bond market. I'm wondering how the bond market is likely to react from any moves we're seeing in the Fed. Do you think that is what is the catalyst for this bond market right now, or is it something else entirely?
I'd say the most recent move has been more of a general risk-off shift, and in these strange times, we turned to different types of data, and we were looking at Google Trends for the Delta variant, and as you've seen the searches shoot up there, you've seen a big downdraft in real yields. You have the 10-year real yield back around -1%. So I think a lot of what you've seen recently has been a risk-off shift that we generally think is overdone at this point. We don't expect the recent increase in cases to result in the same type of broad restrictions that we saw last year, and we don't expect it to really stem this economic recovery that we're looking for globally, certainly here in the U.S. as well. So we think that the recent move is overdone. You're going to have a push higher for the remainder of the year, but to really get a material boost, I think you need to have the Fed more on board with a taper perhaps sooner than the market is anticipating at this point.
Zach, it's good to see you pushing forward to the Fed next week, next Wednesday. We're pushing forward to an ECB decision just moments away. Zach Griffiths there, Wells Fargo senior market strategist. The words used with our good friend and colleague Francine Lagarde just a couple of weekends ago. It was July 11th, and this is what the ECB president Christine Lagarde had to say. It's going to be an important meeting. Forward guidance will certainly be revisited. Tom, I guess in the next hour we'll find out.
Well, we're going to find out. And the press conference, I meant that, it's a joke, but it's not, folks. I'm sorry. John's been in the press conference. The ECB press conference is way, way, way sharper than the Fed press conference. It's like a room full of Michael McKees or Craig Torreses, if you will. And, John, it's going to be interesting.
I like that you've done this, Tom, and not me. You're talking about the quality of the ECB press.
This is not, John, this is not going to be a snooze fest.
I hope it's not.
It's not going to be a snooze fest.
Let's be clear about that. Tom Keene, Jonathan Ferro, Kailey Leinz this morning. Lisa back with us on Monday. Your equity market up 6 on the S&P, advancing 0.1%. Euro dollar unchanged, 117.92. The ECB decision moments away. This is Bloomberg.
With the First Word News, I'm Laura Wright. It's almost as if the pandemic and long tariff war between the US and China had never happened. The two countries are shipping goods to each other at the fastest pace in years. China is buying more from American farm goods, and US imports are described as being through the roof. But the US trade deficit hasn't shrunk, most tariffs are still in place, and there haven't been negotiations over other economic issues. Meanwhile, China is pushing back against the World Health Organization's call for another probe in the coronavirus's origins. The issue, the WHO wants to know if the virus could have leaked from a Chinese lab. Beijing says there's no evidence for that theory, and it defies common sense. Bloomberg's learned that the Federal Reserve Chair Jerome Powell has broad support for his renomination among top White House advisors. Still, the decision is expected later this year and hasn't been put in front of President Biden yet. Powell was appointed as head of the central bank by President Trump. His term expires in February. Wildfires on the West Coast are leading to smoky skies in the east. Strong winds blew smoke from California, Oregon, and Montana. The result, a haze that hung over New York City, New Jersey, and Pennsylvania. People with heart diseases, asthma, and other illnesses were told to avoid the outdoors. It's a sign that travel demand is bouncing back. American Airlines is raising its goal for hiring pilots by 50% through next year. That's according to a company memo to pilots. American's new plan calls for hiring more than 1,300 pilots through the end of 2022. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
September and October are likely to be very rough this year. Maybe, a pullback of 15% or slightly more. But once the Dodgers are at the opening game in the World Series, I think you'll be able to buy it.
If only it was that easy. That was Scott Minerd there, Guggenheim Partners Global Chief Investment Officer. Tom, the call always makes the headline. Before you get into the jokiness of all of it, the call always makes the headline. I'm far more interested in the process. Why September and October? And what does Scott Minerd know that we don't about September and October?
Scott's been a piñata recently. Some people taking some real shots at him. This is a bold call. And the answer is there's some seasonality. Everybody within the game knows October has a certain history to it. And I'll go with that. But, I just want to state, John, this is an outlier call versus a lot of fancy people on Wall Street.
And let me be clear here. The call might be right. The call might be wrong. I'm just far more interested in the process behind a call. Because ultimately, any call, Tom, there is a level of guessing going on here. And September and October is absolutely critical as far as the economic data is concerned. It's when the kids are set to go back to school, and it's when the additional UI ends as well. And everyone's going to be laser focused on what that data looks like, Tom.
Yeah, but in addition, we've got, in September, a view on, we talked about this yesterday, Q4 GDP, and frankly, a first look into 2022. I don't know what that information is going to be yet.
We're going to get a first look at the ECB decision any moment from now, Tom, as we await that, usually a little bit after 45 past the hour. There we go. Unchanged to the ECB. Zero rates, a shocker. Positive 0.25 on a marginal lending facility. Negative 0.5% on the deposit facility rate. I'll get there, Tom. Rates unchanged. We're looking for the guidance. We expected rates to be unchanged.
There we go.
Everybody did. Here we go. A bit of advice for you, Tom. You just got to wait. The PEP will run at least through the end of March 2022. That's the original guidance. They revised some of their forward guidance, Tom, so I'm going to try and work through the details of this. They have affirmed the size of the pandemic purchase program at 1.85 trillion. The APP will continue at a monthly pace of 20 billion. They'll reinvest maturing PEP bonds at least through the end of 2023. The outlook, of course, Tom, from here, well below target at the ECB. PEP to run significantly faster than at the start of the year. We've heard that from the ECB throughout this year, particularly when we saw rates on the Italian 10-year go back through 1%. The ECB is saying they're committed to persistently accommodative monetary policy. The euro so far, Tom, just slightly negative off the back of this. Euro dollar coming in about 0.1%. APP to end shortly before the ECB starts raising key rates. That headline we've seen before, Tom. They will purchase PEP flexibly according to market conditions. Yields, Tom, on the periphery have come all the way in from where they were in spring. The euro right now, euro dollar basically unchanged at 117.90. I'm going to work through these headlines, Tom. You work through these markets.
There's a lot. Okay, I'll go through the markets. There's a lot of adverbs there. Explain the directional tendency of the adverbs in your free time. The 10-year yield in the United States gives a full 1.30%, a higher yield. Futures churning is what I would call it. I don't have the Italian bond up on my screen like John. He can get that. I can't get that on my screen.
GBTP GR10.
Yeah, of course.
GBTP GR10.
What does all this mean,
index.
John? Seriously.
They're going to be around for a while. I think that's the bottom line for the ECB.
2023 is the headline to me.
In terms of reinvesting, yeah, and they could be around for much longer than that. Do a survey. Ask ECB economists. Ask any ECB watcher. Do they think that rates will rise at the ECB for this cycle? And you'll be surprised by how many people say, no, we think rates will stay exactly where they are for the whole of the cycle. It's going to be difficult to get going at the ECB. Conversation in Europe will be very different compared to the conversation in the United States, Tom.
Yeah, I agree with that. And again, as we've seen, we've got other central banks maybe with a little more enthusiasm to be less accommodative. But I'm sorry, John, everybody's making it up as they go. And I would suggest Madame Lagarde will have to say that today in the press conference.
So there you go, Tom. Rates at a present level or lower until the forecasts show some progress. That coming from the ECB, and the forecast right now.
That's a substantial further headline.
So let me give you some of the forecasts, Tom. Just to give you some detail, the forecast right now at the ECB, and I'm working through the Bloomberg here, so bear with me, 1.9% this year on CPI, 1.5% for 22, for 23, 1.4%. We need to see some real progress, Tom, before we have any kind of conversation about raising interest rates. This market, though, is not having a conversation about raising interest rates. This market wants to know what happens beyond PEP, beyond the emergency. What happens with all that flexibility? That's what we want to see. The price outlook must reach 2%, well ahead of the forecast horizon. That seems to be
that word must.
That seems to be the tweak here this morning, Tom. That headline there.
The word "must" there is important. Again, I'll say it. Price outlook must reach 2%, well ahead of forecast horizon. And the euro on that springs higher, 118.13. John, stronger euro.
Stronger euro off the back of this. Euro dollar 118.13. What are we up by? A little more than 1/10%. Tom, I have to say, I'll repeat what I said yesterday, today, a week ago, when Francine Lagarde sat down with the ECB president. I wasn't too excited about this meeting. President Lagarde said it's going to be an important meeting. Forward guidance will certainly be revisited. I think she'll get a lot of questions in about 40 minutes' time in that news conference in Frankfurt.
We must look at that headline, and right now we must go to James Athey, who's aged listening to our analysis with Aberdeen Standard this morning. James Athey, these central banks have 0 degree of freedom. They may even have negative degrees of freedom. Do you really care, or when you invest, do you really invest off what central bank headlines say?
Morning, Tom. That's not really what the headlines say. I think the headlines can often miss, the detail, the nuance, the reality of the policy. Unfortunately, you can't invest in the markets that I invest in. You probably can't invest in any markets without considering to a pretty significant degree what central banks are up to. But I agree with you. They have no degrees of freedom, really. They've dug themselves a massive trap, and they're now stuck in that trap. And there is no central bank that's suffering that problem to a greater degree than the ECB.
Do you think they're stuck down here for the whole of the cycle, James?
Yeah, and beyond. I mean, there's literally... The ECB's problem is that it's trying to use cyclical policy to deal with massive structural issues. There's no economic theory that says that monetary policy has anything more than intertemporal effects, and even fiscal policy, to the extent that it's current spending and not investment, only has a temporal effect, i.e. it brings forward demand from the future to today. It does not in and of itself create demand through the cycle. So the ECB is absolutely trapped. Its job really at the moment seems to be just keeping financial markets from pricing a much more terrifying future and hoping that politicians can get their act together. But I see no evidence that that's occurring either.
I'm just working through this statement right now, and I'm trying to find the big change. And James, I've got to be honest with you, it just feels like a bunch of tweaks around the margins as far as the forward guidance is concerned. this market participants, and the ECB is going to be well aware of this, they want to understand what happens after the emergency ends. What happens with PEP? What happens to all that flexibility? And do the hawks push back significantly enough that in the asset purchase program, beyond the crisis, beyond the emergency, we lose some flexibility? You hearing anything about that this morning?
Not at all. I mean, the market doesn't really care about the underlying economic reality, to be honest. The market wants some certainty around asset purchases because it makes for a very asymmetric market environment, and one in which that you can disregard actual fundamentals and risk and valuation and buy things on the basis that the central bank has your back. That's what the market would like to see. Obviously, the ECB Governing Council has significant disagreement amongst its members, such that there may come a time in the future where that disagreement really does impinge on their policy setting. I just don't think we're there yet because we're still relatively early in the European recovery, and obviously with the Delta variant, there are threats to that recovery that are already emerging. But I'm minded to quote the Bee Gees or Boyzone if you're of a younger generation and say it's only words.
I don't know if Tom knows who Boyzone are. He'll know the Bee Gees though. Do you know Boyzone are, Tom? Boyzone? No.
No.
I don't think he's missing out.
They did a cover of the Bee Gees, Tom, a while ago.
Yeah.
No. Kailey, go on.
I'm going to plead the fifth on whether or not I know who that is,
No, just
John.
carry on, please.
Yeah, just have another piece of dominoes.
James, that was a conversation killer. Don't worry. Kailey's going to pick this up.
All right. Kailey's going to say
James, I want to know when you think the market is going to get some answers. I was speaking with an economist over at Barclays yesterday saying this meeting maybe was overhyped and that, yes, we were going to get, as John says, some tweaks around the margins, but the real answers to what the market's looking for is not going to be coming until September or December. When do you expect us to have a clue what the post-PEP world is going to look like?
Wow, I mean, that's really difficult to say because obviously it will depend on economic outturns and honestly it will depend on what's happening outside the Eurozone as much as it is what's happening within the Eurozone. Again, I don't expect to see any material shift in the structural outlook for the Eurozone, but of course bond markets are highly correlated. And so in this world where the ECB is managing monetary conditions to whatever that actually means, there is always the real danger that tightening from the Federal Reserve can lead to an unwanted tightening from the ECB, and they will seek to offset that almost regardless of the domestic economic data. That is to say, again, the way central banks run their mandates, they're not really too concerned until they get to the steady state as they see it, which is to say that the non-accelerating inflation rate of unemployment, the NERU, when the economy has reached its capacity, then they care about tightening policy. Up until that point, they've absolutely no interest in making marginal adjustments to the policy as they get there. So the ECB, until it gets there, it's not going to want to tighten policy, and it may have to loosen policy to offset a tightening which is coming externally.
James, early pint, or will you watch this news conference in 35 minutes?
I've got a meeting, unfortunately.
There we go. What a surprise.
I will miss it, John.
James, how unfortunate. It's good to see you. James Athey, Aberdeen
Thanks,
Standard
you too.
Investment Senior Investment Manager. Just want to work through the language of this statement that came from the ECB moments ago. This just under the header, monetary policy decisions. They go on to say, the Governing Council expects the key ECB interest rates to remain at their present or lower levels until it sees inflation reaching 2%, well ahead of the end of its projection horizon and durably for the rest of the projection horizon. And it judges that realised progress in the underlying inflation is sufficiently advanced to be consistent with inflation stabilising at 2% over the medium term. And Tom, just to give you an example, this next line here, the amount of heavy lifting that must have taken place at the ECB just to get this next line in, this may also imply a transitory period in which inflation is moderately above target. That just gives you an idea of how tough it still is to work over at the ECB, because I imagine there was a little bit of pushback over just that little line.
A little bit of
pushback. Accept a little bit of an overshoot above the target, so long, of course, that it has the T word attached to it.
John, you're better at this than I am. Weidman, I know off of Reuters article, not striving for high or low rates, the Germanic response ahead of the Bundesbank.
Yeah.
And he talks about the new challenge of the lower bound. That seems to me, John, what this argument's about.
Negative 50 basis points right now.
The new challenge of the lower bound.
The news conference, 35 minutes away.
Why do I want a piece of Domino's pizza?
I don't, you want to talk about Domino's now?
You and me both,
I got
Tom.
Domino's on my brain now because of Kailey Leinz.
Euro dollar unchanged, 117.90. Tom's head in the right place.
Do you think Christine Lagarde's ever had a Domino's pizza?
I doubt it, Tom. This is Bloomberg.
has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
We think it is just a pause as opposed to a phased transition.
People get overwhelmed with information that they can't process, and so they just go, you know what? Risk off.
It's probably not the optimum time to be very overweight on risk.
We are going to see a deceleration in growth, that's for sure. But I think the U.S. consumer will stay quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio, on television, a simulcast on economics, finance, investment. Kailey Leinz in for Lisa Abramowitz today. And it's simple, folks. John Ferro in a press conference is a central banker's nightmare. John, what's the question you would ask the president of the ECB?
I think there's some central bankers here that feel the same way, Tom, right now. I would say, where's the big change? Here are your words. This is going to be an important meeting. What was important about it? And I wouldn't be too snarky about it either. I'd just look at euro dollar and let the market speak for me. Euro dollar right now is totally unchanged, Tom, at 117.89. Yeah. And to get that line in there, this may also imply a transitory period in which inflation is moderately above target. I think that underlines how different the ECB approach is right now compared to the Federal Reserve. The Federal Reserve is taking on this flexible average inflation targeting mode. That's not what the ECB is doing. The ECB has undershot its inflation target, Tom, for years. A decade, and they're not looking to make that up. They're just trying to get back to something, towards something sustainably towards 2%.
The distance from Brainerd to Bullard, just as two examples on the Fed, is an intellectual exercise. The distance from Germany to Finland is a different exercise, isn't it?
I would say the difference from Christine Lagarde and the executive board and the Bundesbank right now, Tom, is much wider than the distance from
This is
Brainerd
important. Explain that.
to Bullard.
Explain that.
There is an agreement on the Federal Reserve about interest rates and flexible average inflation targeting. That's much more of a dovish reaction function than we have over at the ECB. There is an agreement there. We have this very sort of murky agreement over at the ECB, Tom, where we're just approaching 2% so-called symmetrically. I think that's different. The forward guidance that's been agreed over at the ECB is radically different to the guidance that's been achieved, and the framework shift, the reaction function shift over at the Federal Reserve.
And we've got some negative yields, further negative in Europe. They've reversed. We had less negative yields on Germany and on Switzerland. They've turned around and fractionally smaller negative yields. All of this, Kailey Leinz, a distraction for earnings season coming up. Texas Instruments yesterday, other names today. I believe Intel and Twitter are out there as well. Kailey, what have you learned about earnings season so far?
I've learned that beats actually do matter this season, Tom. It seems that in quarters past, even if you beat expectations, that just isn't good enough to meet what a high bar had been set. This season, though, feels a little bit different. It seems actually that earnings are giving an impetus to risk appetite. That beats are being rewarded, and that seems to be what's fueling the risk on feel in this equity market, putting any fears about the Delta variant or the growth outlook kind of to the back burner, Tom.
Quickly, the data, an important conversation on investment allocation here in a moment. John Ferro, there's only one data point today for me that matters. The 10-year U.S. yield, 1.30%.
129.50 right now, Tom, and over the last 48 hours, it's been all over the place. What a trip from 112.60 through 130 late yesterday and early this morning. And Tom, you asked the right question. On what? On what? We're just taking on a life of its own in this bond market, and this equity market's queuing off the back of it.
Yeah, I'm going to go Delta variant is in that mix. Maybe Congress is in that mix. But to me, it's about a boom U.S. economy. John, do we see any lessening of boom economy feel? I don't think so.
I think that many people, though, think we've seen the peak of it just in terms of the rate of change, Tom.
Yeah,
and that's different. That conversation's built up in the last couple of months in a much more material way. And the peak inflation conversation, peak inflation fears, that's part of the story too. Just want to bring up the Italian 10-year, Tom, because you wanted to know.
I can't go forward without it.
3 basis points on the Italian 10-year to 0.66%. Not a big move, but I imagine the ECB's happy it's not moving in the other direction.
I mean, is it to a lower yield now?
A lower yield of 0.66%. 66 basis points, Tom.
That's what you can do in Europe, folks. I'm watching the Swiss 20 negative 0.125, and Kailey Leinz is saying, why am I on this show? Right now, Brent Schutte joining us with Northwestern Mutual. And this is an important conversation about actually what to do with your money given where we are. Brent Schutte, you go all up. I guess it's all yacht on me. You want fixed income as a ballast. Describe that. How are these non-yields going to help my portfolio?
Well, I mean, they're an expensive safety net. And so if you think about it, if you need the money here and now, you certainly don't want to put that money at risk in the equity markets. And so if you're borrowing or if you're taking money out of your accounts, you don't want that at equity risk, and you need to have it in fixed income, even if it's expensive. And so we do suggest that you have some of that if you need that. But all in, Tom, we still do favor equities overall, slightly less than we did at the beginning of the year, but we do see strong economic growth. We do see inflation pulling back, and we see the market moving back towards those cyclical names that do well when economic growth is strong. Jonathan mentioned a peak, but if it's a peak, it's more like a plateau. And you're not going to see significant deceleration until sometime into next year. There is still plenty of room for the economy to run.
Cumulative gains are going to be really important for this bond market too, Brent. And many people in the bond market are focused on that. It just seems to me that rate of change is something that so many people are focused on. That seems to be what's driving markets through the summer. So, Brent, to that point, are you saying that people will be surprised that we'll stay at these elevated levels, that will persist through this year in a way that some people aren't expecting?
Yes. And so you've had the defensive trade come back over the past, 2-3 months as people kind of worried about some of the things that you all just mentioned. So I think you have a lot of cross currents right now. You have the inflation is too much crowd. You have the Delta variant crowd, and you have the stocks are too expensive crowd. And that has all led people to kind of move towards later cycle positioning, such as growth and large cap. I think that as that inflation pulls back in the coming quarters, as economic growth continues to be strong, people will invest in those things that do well when the economy is broad and strong, like cyclicals, value, and small caps, not growth and technology. I think that trade's a bit overdone again, and I think we'll get back to focusing on that stronger economic growth with inflation coming back.
The challenge to that, though, Brent, is in the back end of this year, in Q4, back end of Q3 into Q4, if the supply side of the economy starts to respond in a more material way, that's going to really push out these concerns about high inflation. We'll be back to that low inflation. We'll be back to that low rate story. That feels a little bit more growthy to me. It feels like a NASDAQ trade as compared to, say, a Russell trade. What would your thoughts on that be?
I don't know. I guess it's what you think is moving the bond market. I mean, to me,
Sure.
If the growth is strong and inflation pulls back, I think the yield curve re-steepens. And so I think the U.S. economy actually has a good longer-term story right now. It's called productivity is enhancing. And so if supply starts coming back and then we get through all this labor market slack that we have right now that could go away pretty quickly, I think it's more of a productivity story. And right now that's rising quite a bit, which means the U.S. economy could grow faster in the coming quarters.
Interesting. Good
and
point,
support
Brent.
higher wage growth. And so I just think that people are way too negative right now and are looking to get back to the comfort of growth in large cap. They believe that what you saw the last 13 years is going to be the next 3-4 years. And I don't think that's the case. I don't think we go back to worrying about deflation. I think this economic cycle is different. I think we worry more about the upside to inflation, and that means that people need to position their portfolios just a bit differently and in those things that they all hate right now because it didn't do well for the past few years. That's how investors invest. I'm encouraging them not to. We've had different economic cycles, and every one of them is different. And I think just this time it's more towards the value and cyclical side.
How do you factor long-term economic spending and potential infrastructure spending coming from the Biden administration into that equation, Brent? Have you had to lower your assumptions of what we're actually going to see?
I think that's the big unknown. I think we actually get something done. And I think this time, and I know we opened with the commentary on the ECB and how they're different. I think this time policymakers are going to push on the demand side more permanently. There are still some hawks left, but they're debating whether or not it's 500 billion or 700 billion, not whether it's zero or something else. And so I think on the monetary and the fiscal side, there's going to be more of a demand push this cycle just because of the things that happened last cycle. And I think that means you need supply to keep up with it. And so I think that is kind of the backdrop for a bit higher of a growth rate, a bit higher of an inflation rate. And I worry less about downside. And so to me, that's still pushing you towards those things that do well when economic growth is strong and broad.
Are you tuning into this news conference with President Lagarde in 21 minutes, Brent? I just want to see. I'm just trying to gauge the audience, Tom, to see what they're interested in this morning. 21 minutes, Brent. You've got a meeting as well? You're going to watch?
Actually, I'll be going down to my office in Milwaukee, so I'll be getting out of my basement and moving back towards my office. So I'll listen on the radio.
Just going down to the victory celebration.
Hey, Tom, that was a Bloomberg Radio promo. Let it happen. Let it linger. Thank you, Brent.
And maybe I will go to the Bucks celebration. I don't know. We'll see. It was a pretty good win, wasn't it?
There we go. Brent, I'm happy for you. Janice is quite a player, isn't he? What a player.
Yes, he is.
It took a Greek man to come here to America and show people how to play basketball. Brent, it's good to see you. I'll let that linger too. Brent Schutte, Northwestern Mutual
John,
Chief Investment Strategist. Yes, Tom.
Let me give you the granularity of the Bloomberg. Folks, this is why the Bloomberg is so good. We have a headline team. They're down under the Home Depot here at Lexington and 57th. We hide them. And the headline team, John, brings in these press releases and gets this stuff out. Union Pacific, they're trained and they're struggling with a pandemic and, the goods shortage and the chip thing and all that. Average train length, 1.78 miles, up 9%. Look what you can learn from the Bloomberg, John.
Thank you, Tom. That's a nice promo.
Do they have trains that long in the United Kingdom?
I have no idea. Unlike you, I won't pretend I know either. I'll have a look in a commercial break. I'll see.
You get to the train side, and you're in Western Indiana, like near
When was
Purdue.
the last time you got a train?
Years.
How many years? Come on. How many years? When was the last time you got an Amtrak?
I do take the Excella every once in a while
you?
when I go down to harass Anne-Marie Horton.
Okay.
But John, seriously, you're in Western Indiana, somewhere outside Purdue, and you're stuck at a rail crossing, and the train is 1.78 miles long.
Okay. Tom, I'm going to share something with our audience. Whenever you bring up Purdue, which is the previous school of our manager, it usually means you've done something wrong.
You got that right.
What have you done wrong?
I ordered Domino's pizza.
Is that what you did?
Yeah.
All right. I bet
I
it's
hope
worse
that's
than
true.
that. Coming up today, after the news conference with the ECB, a must-watch apparently. Peter Pratt, former
Someday the
ECB
trains will be
economist,
2 miles
will be joining us.
2 miles.
Your equity market on the S&P 500. Up by 0.05%, coming off the highs. Your bond market, your 10-year yield, looks like this, 129 on 10s. Yields unchanged from New York. This is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden is dismissing concerns that the U.S. would experience persistent inflation. He told a CNN town hall last night there will be near-term inflation because the economy is improving. Still, he said that restaurants and others in the hospitality industry might take longer to recover because of hiring difficulties. While the Senate works on the infrastructure bill today, President Biden will host a business and labor leaders lunch at the White House. He'll make the point that the two frequent adversaries have come together to support the bipartisan infrastructure framework. Senate negotiators are close to a deal that would allow lawmakers to begin debating the legislation. The US and Germany have made it official. They finished a deal approving completion of the controversial Nord Stream 2 pipeline. That effectively ends a long-standing dispute over German gas purchases from Russia. The deal calls for Germany to take action if Russia tries to use energy as a weapon against Ukraine. Mercedes-Benz is promising to spend more than $47 billion this decade to electrify its lineup and to defend its position as the world's best-selling luxury car maker. Mercedes plans to launch 3 new all-electric vehicle platforms in 2025. It will also set up 8 more battery factories with partners. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
This is an existential issue. We already see people in various parts of the world losing their lives to the impacts of climate crisis, and we need to respond. The 20 countries that are the major economies of the world really need to step up and come up with reductions that can keep the minimal amount of damage possibilities in focus.
John Kerry there, the US Special Presidential Envoy for Climate. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Kailey Leinz. Lisa, back with us this coming Monday. Your equity market looks like this going into the opening bell. 1 hour, 12 minutes away. Also 12 minutes away from jobless claims in America. And before we hand over to that news conference with President Lagarde of the ECB, we'll bring you that jobless claims data. Yields unchanged at 128.49. Just had a little sneak peek of 130 a couple of hours ago. Yields unchanged now. Your euro, slightly negative. Euro dollar, negative 0.15%. We can call it negative 0.15% unch if you want.
Okay.
Basically unchanged. Just a touch of euro weakness. Going into that news conference, Tom.
It'll be interesting to see T-minus 11
T-minus,
minutes and counting.
yeah, T-minus 11 and 13 seconds.
We don't go to tenths of seconds. There may be a launch delay. Okay, let's do this. Ira Jersey with us right now, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And usually with Ira, I go to the trust market, short-term paper, overnight, 6 months. Not this time. Ira, let's go bigger, broader. Maybe a question President Biden would ask of Ron Klain. Where are the foreigners? What are the foreigners doing? Not saying, what are they actually doing with bonds, notes, and bills?
Yeah, so it seems like, Tom, that these that foreigners are a big reason that we've seen Treasury yields go significantly lower over the last couple of months, and I think not even months, really, just like 3 or 4 weeks. So, and the way that we can ascertain that is not through data, because unfortunately we don't get a lot of the flow data for another couple of weeks. But what we do have is we know that most of the move in Treasury yields over the last month or so have really come during European hours. So basically from 1 o'clock in the morning New York time to about 7 o'clock New York time. Yeah, so that signals that a lot of this buying is coming from foreign investors who are looking for a flight to quality, and I think certainly what we had underappreciated was the significant challenges that economies are still having with the pandemic in the emerging world and in Asia and parts of Africa and even Eastern Europe. So when you still have significant caseloads and lockdowns continuing there, people are still going to look for the flight to quality, and treasuries are still that asset of choice when all else it doesn't seem to be going very well.
Ira, we just had a conversation with James Athey of Aberdeen Standard, and he said we face the very real prospect, that this ECB won't be able to hike through this cycle. It's not alone. I've heard it from so many people, even optimistic people on the continent, saying the same thing. If we're stuck down here at negative 50 basis points to the ECB, what does it mean for the whole cycle? Not the moment we're in, not in moments where you need some safety. I mean the whole cycle, regardless of risk sentiment.
Well, based on the statement that came out this morning, it seems like the ECB might actually even be buying more assets. So it's not only, will the ECB be able to hike this cycle, but will they actually be able to stop buying bonds at some point during the cycle? So that that has to be the first impetus. And it seems like the ECB is somewhat more dovish. So again, I think that the whole global interest rate cycle is significantly challenged by the uncertainty about how fast growth can be. Because even though growth in the U.S. might be okay in the not too distant future, we're still worried about the global implications of growth. And let's face it, with supply chains the way they are, with the way that the interconnectedness of the global financial markets, if like you say, John, if German yields stay at negative 50 basis points, it's going to be hard to see U.S. yields rise much above 2%.
Yeah, and this is the issue when it comes to the reaction function as well. The Federal Reserve, I would argue, has a much more dovish reaction function than the ECB. The difference, Ira, is that the Federal Reserve's reaction function is likely to be tested and the ECB's won't be. So what's going to drive treasuries here? The Fed, the data in America, or everything else outside?
Well, I think lately it has been everything else outside the U.S. because the U.S. data has not been terrible. And in fact, we were looking for a couple of weeks, we were really looking for the reason and who was buying, because everyone we talked to in the U.S. is like, we don't like yields here. The yields are too low. They're not attractive. So we couldn't really find the buyers here domestically. So that's when we had to go abroad and start to look outside the U.S. for, who are the buyers. So there still are buyers, like pension funds and insurance companies, that are still seeking yield because they have to buy something and they'd rather buy, U.S. assets at, even 1% instead of buying German assets at negative 25, 50 basis points.
The U.S. still the highest yield you can get when it comes to sovereign bond markets. Ira, what do you think is going to break us out of this 1.3%, sub 1.5% range? What is the near-term upside catalyst for yields?
Well, I think in the U.S., it's not going to be inflation. I think inflation expectations are probably stuck. So I think it is looking at the Fed, and are they seriously considering tapering. You have the ECB talking about maybe even buying more bonds come the fourth quarter of this year. But if the Federal Reserve tapers, I do think that you will get a meaningful reaction out of the bond market.
Ira Jersey, I just got to say, and for those of you on Bloomberg Radio, it is a sight to behold. Ira Jersey is so large among our 19,000 plus employees that in his latest agreement, John, he demands to be arm's length to the food court. And he's like,
I can't leave my desk, Tom. There's so much going on.
He's literally, John, an arm's length away from the beloved Cheez-Its that we have at Bloomberg.
I don't think he's here, though. Are you at Princeton? You in Princeton?
I'm in Princeton, yes.
See,
I'm in the Princeton.
He's in Princeton. You can sit closer to the snacks in Princeton, Tom. That's the difference.
John, you and I are like a 5-mile hike. It's like Abramowitz out, in the Adirondacks doing one of her portage canoe things for us to get to the food
Before
court.
we go, just a quick question. What do you want to hear from ECB President Christine Lagarde in 5 minutes' time?
I do want to get some clarity as to their how they're going to respond to their new operating framework, and will they be buying more assets, and maybe announce that in September.
I think that's really important. Ira, it's good to catch up. Ira Jersey, Bloomberg Intelligence Chief, US interest rate strategist. Look, Tom, if forward guidance has changed, if this is supposedly a more dovish stance, more tolerance for higher inflation, then don't you have to change your policy? Right now, the inflation outlook is as follows: 1.9 to 1.5 to 1.4. So with that in mind, do you have to A, change your policy, or B, acknowledge that you don't have control over your ability to hit that target?
I would channel Richard Claret and, frankly, the wonderful John Taylor of Stanford. If you mention symmetry, you have to define symmetry. Have they defined symmetry? I don't think so.
No, I don't think so either.
Yeah.
I think this is going to be an interesting one. In 5 minutes' time, full coverage right here on Bloomberg TV and radio of that ECB news conference.
Dominoes.
And then we'll have jobless claims for you just before that. And Tom will be saying erratic
Kaylee, have you ever had Dominoes and Cheez-Its together?
Kaylee, just don't. Just don't. Is that how excited you are about this presser?
Oh, I am. Yeah,
you're focused on the snacks that you'll be eating.
I've never double-barreled Dominoes and Cheez-Its.
In the presser? From New York City this morning. Heard on radio,
Can I
seen
get
on
some
TV.
more Tang, please?
Equity futures up 0.1%. A beautiful one in London too. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio, your news conference in Frankfurt, Germany with ECB President Christine Lagarde just moments away. Before we get there, claims data in America and a little bit of other data points sprinkled in between. With those numbers, here's Mike McKee.
Thank you very much, John. We see 419,000 jobless claims filed, initial jobless claims filed last week. That's interesting. It's an up from 360,000, which is a change from the previous week. We haven't got a revision yet, but it does go the wrong way. 350,000 was the anticipated number. We get 3,236,000 continuing claims, and that is a little bit lower than last week, 3,241,000. So not a lot of changes here. Basically, an increase of 51,000 from the previous week. And the interesting thing about this is it was the survey week for payrolls. So we'll see that figure into somebody's estimates as we go forward.
Michael, we're constrained on time because of Christine Lagarde and the ECB, but clearly I've been screaming this is an elegant chart. With this data point, it's not elegant. It's less elegant. It's a little bit of a movement from the constructive trend. Will the politicians see that in Washington?
No, they're going to argue about it the way they want to, but basically economists will say, data is lumpy.
One data point.
Comes up. Yeah. So I wouldn't worry too much about it overall. The total number of claims, 12,573,000 for July 3rd. That is down by a little under a million. So significant progress made towards getting people off the rolls.
The wrong kind of upside surprise on jobless claims. That's the story here in America. Let's head over to Frankfurt, Germany. ECB President Christine Lagarde said herself coming into this one, it's going to be an important meeting. Let's take a listen.
So, good afternoon. The Vice President and myself welcome you to our press conference. At today's meeting, the Governing Council focused on two main topics. First, the implications of our strategy review for our forward guidance on the key ECB interest rates. And second, our assessment of the economy and our pandemic measures. In our recent strategy review, we agreed a symmetric inflation target of 2% over the medium term. Our policy rates have been close to their lower bound for some time, and the medium-term outlook for inflation is still well below our target. In these conditions, the Governing Council today revised its forward guidance on interest rates. We did so to underline our commitment to maintain a persistently accommodative monetary policy stance to meet our inflation target. In support of our symmetric 2% inflation target and in line with our monetary policy strategy, the Governing Council expects the key ECB interest rates to remain at their present or lower levels until we see inflation reaching 2% well ahead of the end of our projection horizon and durably for the rest of the projection horizon. And we judge that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term. This may also imply a transitory period in which inflation is moderately above target. Let me now turn to the assessment of the economic outlook and our pandemic measures. The recovery in the euro area economy is on track. More and more people are getting vaccinated, and lockdown restrictions have been eased in most euro area countries. But the pandemic continues to cast a shadow, especially as the Delta variant constitutes a growing source of uncertainty. Inflation has picked up, although this increase is expected to be mostly temporary. The outlook for inflation over the medium term remains subdued. We need to preserve favorable financing conditions for all sectors of the economy over the pandemic period. This is essential for the current rebound to turn into a lasting expansion and to offset the negative impact of the pandemic on inflation. Therefore, having confirmed our June assessment of financing conditions and the inflation outlook, we continue to expect purchases under the Pandemic Emergency Programme, our PEP, over the current quarter to be conducted at a significantly higher pace than during the first months of the year. We also confirmed our other measures to support our price stability mandate, namely the level of the key ECB interest rates, our purchases under the Asset Purchase Programme, our reinvestment policies, and our longer-term refinancing operations, as all that is detailed in the press release published at 1:45 today. We stand ready to adjust all of our instruments as appropriate to ensure that inflation stabilizes at our 2% target over the medium term. I will now outline in more detail how we see the economy and inflation developing, and then talk about our assessment of financial and monetary conditions. So looking at the economic activity. The economy rebounded in the second quarter of the year, and as restrictions are eased, is on track for strong growth in the third quarter. We expect manufacturing to perform strongly, even though supply bottlenecks are holding back production in the near term. The reopening of large parts of the economy is supporting a vigorous bounce back in the services sector. But the Delta variant of the coronavirus could dampen this recovery in services, especially in tourism and hospitality. As people return to shops and restaurants and resume traveling, consumer spending is rising. Better job prospects, increasing confidence, and continued government support are reinforcing spending. The ongoing recovery in domestic and global demand is boosting optimism among businesses. This supports investments. For the first time since the start of the pandemic, our bank lending survey indicates that funding of fixed investment is an important factor driving the demand for loans to firms. We expect economic activity to return to its pre-crisis level in the first quarter of next year. But there is still a long way to go before the damage of the economy caused by the pandemic is offset. The number of people in job retention schemes has been declining, but remains high. Overall, there are still 3.3 million fewer people employed than before the pandemic, especially among the younger and lower skilled. Ambitious, targeted and coordinated fiscal policy should continue to complement monetary policy in supporting the recovery. In this context, the Next Generation EU programme has a key role to play. It will contribute to a stronger and uniform recovery across euro area countries. It will also accelerate the green and digital transitions and support necessary structural reforms that lift long-term growth. Let's look at inflation. Inflation was 1.9% in June. We expect inflation to increase further over the coming months and to decline again next year. The current increase in inflation is largely being driven by higher energy prices and by base effects from the sharp fall in oil prices at the start of the pandemic and the impact of the temporary VAT reduction in Germany last year. By early 2022, the impact of these factors should fade out as they fall out of the year-on-year inflation calculation. In the near term, the significant slack in the economy is holding back underlying inflationary pressures. Stronger demand and temporary cost pressures in the supply chain will put some upward pressure on prices. But weak wage growth and the past appreciation of the euro mean that price pressures will likely remain subdued for some time. There is still some way to go before the fallout from the pandemic on inflation is eliminated. As the economy recovers, supported by our monetary policy measures, we expect inflation to rise over the medium term, although remaining below our target. While measures of longer-term inflation expectations have increased, there remains some distance from our 2% target. Let us look at our risk assessment. We see the risks to the economic outlook as broadly balanced. Economic activity could outperform our expectations if consumers spend more than currently expected and draw more rapidly on their savings, those they have built up during the pandemic. A faster improvement in the pandemic situation could also lead to a stronger expansion than currently envisaged. But growth could underperform our expectations if the pandemic intensifies or if supply shortages turn out to be more persistent and hold back production. What about the financial and monetary conditions? Well, the recovery of growth and inflation still depends on favorable financing conditions. Market interest rates have declined since our last meeting. Financing conditions for most firms and households remain at favorable levels. Bank lending rates for firms and for households remain historically low. Firms are still well-funded as a result of their borrowing in the first wave of the pandemic, which in part explains why lending to firms has slowed. By contrast, lending to households is holding up. Our most recent bank lending survey shows that credit conditions for both firms and households have stabilized. Liquidity remains abundant. At the same time, the cost for firms of issuing equity is still high. Many firms and households have taken on more debt to weather the pandemic. Any worsening of the economy could therefore threaten their financial health, which could trickle through to the quality of banks' balance sheets. It remains essential to prevent balance sheet strains and tightening financing conditions from reinforcing each other. So, summing up, the euro area economy is rebounding strongly, but the outlook continues to depend on the course of the pandemic and progress with vaccinations. The current rise in inflation is expected to be largely temporary. Underlying price pressures will likely increase gradually, although leaving inflation over the medium term still well below our target. Our policy measures, including our revised forward guidance, will help the economy shift to a solid recovery and ultimately bring our inflation to our 2% target. Thank you very much. We're now ready to take your questions. Over to you, Volkan.
Thank you, President Lagarde. And today, the first question goes to Balazs Kourani of Reuters. Balazs, please.
Good afternoon, and thanks for taking my question. President Lagarde, could you run me through your discussion on changing the forward guidance? We hear that you couldn't get unanimity on the guidance 2 weeks ago. Did that happen today? Was the forward guidance supported unanimously, or was there dissent? How is this guidance different than what you discussed 2 weeks ago? Second question is about the Delta variant, which you mentioned a couple of times. We know it's more contagious, and UK infection numbers are rising quite rapidly. Do you see a risk that the emergency phase of the pandemic will last longer than now many think because of Delta? Is Delta properly factored into your risk assessment? Thank you.
Well, I will need at least an hour to go through all your questions because you cover huge ground. So let me tackle your first question, which had to do with how we reached our decision in relation to forward guidance. Let me take you back just a little bit to our strategy review and the strategy, the monetary policy strategy that we adopted unanimously. And you have to think in terms of the strategy that we adopted as the framework within which we weave monetary policy. And there was unanimity on the framework. This is really the basis against which we develop monetary policy as we go and depending on circumstances. So unanimity there. There was unanimous agreement around the table that we had to revise our forward guidance, and that forward guidance had to implement our strategy review. We did not have unanimity, but we had an overwhelming majority about the calibration of the forward guidance on ECB interest rates. But that's what I had anticipated. And what matters most is the fact that directionally we were all on the same page and determined to revise the forward guidance as we did, but also to make sure that it is geared to implement our strategy. So that's very bluntly how it happens, and what matters really is this chain of event, if you will, amongst us. Now you ask me to sort of dissect the forward guidance that we adopted. And if you don't mind, I'm going to take you through a little exercise of going through that long sentence, which is probably the one that is a little bit more lengthy in the whole presentation that I gave you. And it's a bit more lengthy because the forward guidance rests on three key criteria, if you will, or it has three legs, our forward guidance. And I'll take you through that. So, first of all, in support of our symmetric 2% inflation target and in line with our monetary policy strategy. So we are well anchored in our strategy. We remind ourselves that we are targeting 2% inflation, and our commitment is symmetric. The Governing Council. So it is not relying on any kind of projections. It is the Governing Council in its judgment that expects the key ECB interest rates to remain at their present or lower levels until, and that's when it begins to be important, we see inflation reaching 2% well ahead of the end of our projection horizon. That's leg number one. And leg number two, durably for the rest of the projection horizon. And third leg, we judge that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term. And we add to that a sentence that you might remember from the strategy review, which is, this may also imply a transitory period in which inflation is moderately above target. So, by these three legs, we're essentially saying, first of all, that we want to see inflation reach 3%, well ahead of the end of our projection horizon. Now, you might say, what is well ahead? Well ahead, first of all, is determined by judgment of the Governing Council. But it is essentially the midpoint in our overall horizon. And just to remind those of you who do not necessarily know what our projection horizon, at the moment we project 21, 22, 23. So we want to see 2%, at least 2% on the horizon, but well ahead of the end of this horizon. The second aspect is that we want that 2% to be durable. So we want it, and that's the second part of in the statement, it says durably for the rest of the projection horizon. So it can oscillate a little bit, but it cannot go below 2% essentially. And the third one, which is important as well, is that we want to look at the current circumstances, and in particular the current underlying inflation, to see whether directionally this underlying inflation components actually lead us into that upward trend that will help us reach the 2% target that we are committed to. So you've got three legs. One that is in the present. You could argue that there is an element of outcome based in that one, where we look at the underlying inflation factor and we see whether directionally we're aiming towards our target. Then we want to see it on the horizon, but we want to see that to have been sufficiently lasting so that essentially at midpoint it is already there. The third question that you asked me had to do with the Delta variant. And on that particular point, our projection from June actually included some assumption that certain containment and lockdown measures would be continued into the third quarter, and some of it still remaining during the fourth quarter of 2021. So it is factored into our projection, and all the elements that we are observing at the moment, whether it's by way of PMI or whether it's hard data, are really confirming our projection for the second quarter, which is coming strongly, and for the third quarter. So we don't, we are in the hands of those who are going to take all the necessary precaution to make sure that that contagion is not producing the negative economic effects that we have seen in the past. So vaccination is clearly one of the components that we look at carefully. The second consideration that we debated around the table, because it varies from one country to the other, is the fact that over the course of those waves, first, second, third waves, and now fourth waves, our citizens, governments, health services are getting a bit more used to the responses that must be given in order to address the health of people, but also not to damage too much the economy. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much, President Lagarde. I have a question on how you see how the market is interpreting what you have said today. It's clearly seen as a dovish message that rates and monetary policy will stay lower for longer. Would you agree? And then I have a question on whether you have discussed PEP and a potential change in the program once it is expiring by the end of March, whether you think it's needed that it has to transition into some sort of other program. That would be it for now. Thank you.
Well, thank you so much. You know, I have tried to describe as well as I could the forward guidance on ECB interest rates and the fact that it is really taking into considerations three key criteria over the space of time in order to make sure that we have solid, lasting elements that will actually be useful to guide our action. I wouldn't say it's lower for longer. I would say that it's an indication that none of us would want to tighten prematurely. I think we're informed by past experience and by most recent history. And I think this element of patience that you have between the midpoint and the end of the horizon, and the fact that it has to not only be sufficiently early and way ahead, as is indicated in the forward guidance, but also lasting, is precisely intended to avoid premature tightening that would be detrimental for the economy. So I think the combination of patience in order to gain confidence is what we discussed and what we tried to embed in that sentence. On the rest, essentially I would summarize it by steady hand. So the use of our instruments such as PEP, APP, has been steady hands, because we conducted the joint assessment that you're all now familiar with, which is to assess the financing conditions and determine whether they're favorable all the way through, from market interest rates all the way to household loans. And then we take a good look at inflation and its various components. So based on that joint assessment, which essentially is broadly in line with what we saw in June, we decided steady hand to keep this significantly higher pace of purchases compared with what we did in the earlier month. But PEP, that was not discussed as a program, and anything like that would be totally premature. So it was not an issue for debate.
Thank you. And now to Caroline Look from Bloomberg for the next question. Caroline, please.
Hi, good afternoon, and thanks for taking my question. President Lagarde, your new 2% target was quite front and center when it came to your plan for interest rates today. You said that inflation should reach 2% well ahead of the end of the projection horizon, but your last projections in June actually saw inflation moving away from this 2% target. So what are you going to do about that? And doesn't this imply that a more forceful response is needed? And secondly, again, on this well ahead of the end of the projection horizon, you just mentioned that that means about the midpoint of your projections. So are we right to be looking more at the second year?